So before break, we were studying about revenue. Now we'll be starting with a chapter called financial instruments. Financial instruments we are studying today, but will not be completing today. We'll be completing by tomorrow end of day. Okay. So for today, we'll be studying from the point of view of the definitions, from the point of view of the split accounting, from the point of view of compound financial instruments. Okay, only this much. Now, but yes, only thing I'll request all of you is after this class will be useful to all of you only and only if after the class you go and revise. Okay, and solve all the questions and whatever queries you have, please bring it with me. Okay. In the last day or after the last day, I think one more day I'll keep it. If you guys have any queries, I'll take the whole session only for the queries. Okay, but do accumulate all your queries. Okay. Also, if you want to discuss any other queries, even after the sessions, if I forget, I'll give my contact number as well. You can WhatsApp me on this number. Okay, so this is my personal contact number, so you can directly message on this number. I'll resolve all the queries. Yes, it might take some time if I'm in the class. Otherwise, it will be resolved. Okay. Now, coming to the chapter called financial instruments. Now, what is the meaning of financial instruments? Let's understand first what is the meaning of financial instruments. So, when we say financial instruments, understand first and foremost the important point is it should be a contract. It should be a contract. It should be a contract. And now the contract that give rise to financial asset for one party and a financial liability or an equity for another party. Let me give examples. Let's suppose I have given you a loan. Okay. For you, it's a financial liability. For me, it's a financial asset. Now, let's suppose you have invested in the equity shares of my company. For you, it's a financial asset. For me, it's an equity. Now, what happens? For one party, constantly it will be a financial asset, but for the another party, it will be either a financial liability or an equity. To give an example, other way around, see this one, Reliance. Okay. This is a bank. Okay, Reliance takes a loan from the bank. Okay, so what happens for the bank? It is asset. You can say financial asset, and for Reliance it is financial liability. Now, what happens? Reliance issues equity shares in the market. Okay, and gets the funds. So for Reliance it is equity, and for the general public it is financial asset. So always it will be financial asset for one party and it will be either a financial liability or an equity for another party. Clear? Now, to understand the meaning of financial liability and financial asset and equity, just forget everything what is given in the standard. Understand only one thing. Financial liability is nothing but a contractual obligation. Contractual obligation. Now you will say when let's suppose in the revenue standard we received the money. Okay, and we have to give the goods or services. There also there was a contractual obligation. So was it a financial liability? No. Why? Because the contractual obligation was settled by delivery of goods or services. If this delivery will be in the cash or any other financial asset, that is a financial liability. Okay. So whenever you have an obligation, that is arising by virtue of a contract which will be settled by outflow of cash or any other financial asset, is a financial liability. Understand? If there is no obligation, not a financial liability. If the obligation is there, but that is not contractual, that is not a financial liability. If the contractual obligation is there, but it will not be settled by cash or either financial asset, it is not a financial liability. So the three terms which are important is contractual, obligation by settled of cash or either financial asset. Okay, that's the meaning of a financial liability. It's a contractual obligation. It's a contractual obligation to deliver cash or any other financial asset. Contract is very important, obligation is important, cash is important. Okay, then only it will be a financial liability, otherwise no. Now, to give an example, provision for tax is an obligation I have to pay, right, which will be settled by cash or in the financial asset, but that is not contractually, that is statutory, right, that is not contractual. So again, it is not a financial liability. So that is called as statutory liability. Okay, so a contract should be there, obligation should be there, settled by cash or in the financial asset. Now, that's a financial liability. Now, coming to financial asset, cash and bank is a financial asset. Investment in equity instruments of another company is a financial asset. Now, just opposite to financial liability, it's a contractual right. It's a contractual right to receive cash or any other financial asset. Again, three things are important here: contractual right and cash or any other financial asset. Is it clear, everyone? Now, so I believe these three terminologies are very much clear, and here this one is very much clear. Right? Now comes to the rest 2 and the rest 2 here. I'll discuss that. First, let's come to equity. Now, what is the meaning of equity? Equity is a residual interest. Okay. Now, let's suppose I have invested 1,000 in the company and I have taken a loan of 1,000 from the outsider. Okay. After doing business for 3 years, I think that I have to wind up the company. And from the company, I sold all the assets and realized 1,500. So, this 1,500, how will I settle first? I do have 1,500 in my hand. I do have two options. Option number 1, I'll pay 1,000 to myself first, and the remaining 500 I'll pay to bank. Option number 2 is I'll pay 1,000 to bank first, and the remaining 500 to myself. Tell me, 1 or 2? 2, right? So why? Because bank is an obligation. I've taken a loan from the bank, right? So what I'm paying to myself is a residual. Whatever remains is mine, right? So that is called equity. Equity is the residual interest. Whatever remains is forms equity. Is the residual interest in the net assets of the entity, that is after paying all the liabilities. So this is also clear now, right? Now comes these three parts. Now let me explain. Financial asset. Under financial asset and under financial liability, I have written one thing. Just a minute. Let me just copy it for you guys, okay? So I have written here contractual right to receive cash or any other financial asset in potentially favorable condition. Now here it is contractual obligation to pay cash or any other financial asset in potentially unfavorable condition. Now, what is the meaning of this one? Let's suppose we enter into a bet, okay, that India will win the match today, and if India wins, I will give you 1,000. If India doesn't win, you will give me 1,000. Okay, this is the bet. Now, understand, either it will be favorable for me or it will be for you, right? If it is favorable for me, it will be unfavorable for you, or the vice versa. Now, if it is favorable for me, and we have been assuming that we have a contract, so don't you think I have a contractual right to receive cash flow if it is a potentially favorable condition for me? So these type of financial assets are called as derivative assets, derivative financial assets. And now if it is a financial liability, it is called as derivative liability. Is it clear? Now, what is the meaning of a derivative? No, low or nil initial investment. When we intend to bet, any investment required? No. Settled at a future date? Yes, it will be settled at a future date. Now, third was its value is derived from the underlying, right? So underlying is there the cricket match. So that is called as the derivative. That is called as the derivative. Now, I believe this one is also clear to all of you. The contractual right to receive cash or any other financial asset in potentially favorable condition, that is derivative asset. Now here it is contractual obligation to deliver cash or any other financial financial asset in a potentially unfavorable condition. That is also clear. Now again comes the third part. Contract that will or may be settled in entities' own equity instruments is called as financial liability. Forget, okay, come here. This is the line written here. Financial liability, contract that will or may be settled in entities' own equity instruments. Now understand, forget the word may. What is the meaning of contract that will be settled? Means mandatory to be settled in equity instruments. What does it mean? Compulsorily convertible, right? Now contract, now forget this word now, just a minute. Forget will and just remember may. May means what? Optionally convertible, right? Now it says if there is any contract that will or may be settled in entities' own equity instruments, but the instruments are variable in number, that is also Financial liability. Now what is the crux of it? Understand. If the instrument is convertible, it can happen in two forms: compulsorily or optionally. If it is compulsorily, then it can happen again in a fixed number of equity shares or variable number of equity shares. Optionally, again fixed number of equity shares and variable number of equity shares. Now, if it is fixed number of equity shares, compulsorily and fixed, it will be equity. If it is compulsorily and variable, see covered here, will and variable, it will be financial liability. Now, optionally, later in this class we'll study whenever a instrument is optionally convertible into equity instruments. Let's suppose I am the entity, I have issued an instrument which I said to you guys that it will be you do have an option that at the end of the tenure you can demand for cash or you can take equity. Tell me, if at the end of the third year you tell me that sir I want cash, can I deny? No. That person says me, sir I want equity, can I deny? No. But now, being conservative, don't think I'll say if someone asks me cash, I cannot deny that. Means, can I say there is an obligation for myself, right? There is an obligation, and if there is an obligation, what does it become? It becomes liability. So whenever the instruments are optionally convertible, it will always be financial liability. Okay, doesn't matter whether it's fixed number of equity shares or variable number of equity shares. If it is optionally convertible, it will always be financial liability. So that's what it means here. See, now again, contract that will or may be settled and entities own equity instruments that are variable in number, which will be called as financial liability. Is it clear, everyone? Now, contract that will be settled in entity that will be, see, that will be means what? Will means what? Compulsorily. That will means compulsorily. Compulsorily settled in equity own instruments that are fixed in number means if it is convertible, compulsorily convertible and fixed in number, it is then only it will be called as equity, otherwise no. Is it clear, everyone? That's the meaning of the financial asset, financial liability and equity. Is the meaning clear, everyone? Understand one thing, whenever you have an obligation, you have to see your obligation is for what. If you have an obligation to give cash, financial liability. If you have an obligation to give any other financial asset, financial liability. If you have an obligation to give equity, that is compulsorily convertible, obligation to give equity that is compulsorily convertible, I'll see, oh, it is fixed number, equity, variable number, financial liability. Okay, now tell me why whenever it is variable number of equity shares, we say it as a financial liability, why not equity? Okay, I'll explain this. Pardon? Liability will change, not exactly, let me explain. So what happens, let's suppose I have given, I have taken a loan from you for 10 lakh rupees, okay, I have taken a loan from you for 10 lakh rupees. Now, for 3 years, at the end of third year, I say that I have to give you 10 lakh rupees cash, this is financial liability. I said when I took a loan, now I said what I will do is at the end of third year, I will give you 1000 equity shares of my company, okay. Now understand, the value of these equity shares might change, right? Now, irrespective of whatever is the value, then I will give you 1000 equity shares only, right? But now if I say I will give you equity shares, sufficient number of equity shares based on the fair value of equity shares at that time. So now what will happen at that point of time, during the time of settlement, I will say, okay, I have to pay 10 lakh, this is the value of equity share, this is what number of equity shares I'll give him. So what I am doing, though I am giving in equity shares, but I am giving equity shares worth 10 lakh only, right? So equity shares are just used as a mode of currency, okay, rather than settling in equity shares, it is just used as a mode of currency, okay. So that's the reason why it is called as a financial liability whenever it is variable in number. Now understand when it will be equity and when it will be financial liability. When I have told this to my to the person whom I have issued the instrument, okay, at the date of issue, okay, when I'm issuing the loan, when I'm taking a loan, on that very date, okay, I'll show it here. Understand? Let's suppose I have taken a loan here, I will settle it here, okay, a loan of 10 lakhs, I will settle by equity shares, by equity shares I will settle. Okay, sufficient number of equity shares means you will say it as a financial liability, right? So you will have to classify it as a financial liability till here. Now once you issue equity shares, it will be equity only. But because what mistake that students done in the exam, when I say financial liability, they think here it is financial liability. No, here it is not a financial liability. Here, when the equity instruments are issued at whatever terms, that doesn't matter. But here it will be finance equity only. Whether it is equity or financial liability, we have to do the classification here till the time it is not issued. Is it clear, everyone? Now coming to applicability. So it says that investment in subsidiaries, associates, and joint ventures, right? We do have an option to measure it either at cost or at fair value. If we are measuring it at cost, it is not under the purview of financial instruments. Okay. Now rights and obligations under finance employee benefits plans, right? That is still not under the purview of financial liability or financial instruments. Under insurance contracts, again no. Lease contracts, again no. Share based payment transactions, SBP liability is not a financial liability. Okay, no. Indemnification asset, no. What do you mean by indemnification asset? Can anyone tell me? What do you mean by indemnification asset? No. Let's suppose what happens, we discussed about provision in the revenue chapter, right? So what happens when I will incur a cost for repairing the machine? What happens is I have to recover this cost also from someone. Okay, me as an entity got this product manufactured from someone else, and we had a term that if a customer comes to me for claiming the repairs, I will claim the whole amount from you. That asset which I have to recover from him is called as indemnification asset. Okay, see here also there is a contractual right to receive, right? That is called indemnification asset, but it is covered under Ind AS 37, right? In Ind AS 37 we do create provision also. This indemnification asset is also covered there. Now forward agreements for business combination, meaning thereby agreement to purchase of further equity shares for business combination, for acquiring the control, is also not covered here. Contract asset or contract liability under revenue contracts, again not covered here. Okay, certain loan or financial guarantees which we will study in the next class is also not covered here. They are covered under Ind AS 37. Okay, now executory contracts. Let's suppose I have entered into a contract to purchase a mobile phone. Okay, and I know I will take the delivery of mobile phone. Is that a financial instrument? No, that is not a financial instrument, because any contract to purchase or sell a non-financial item is not a financial instrument. But yes, if I intend to do this net settlement of this one, then it will become a derivative contract, right? Which we'll discuss about executory contracts in the next class. Okay, so this is the meaning and applicability of the standard. Now, however, understand this standard is applicable on the following: if there is an investment in subsidiaries, joint venture, or associates measured at fair value. So if you measure your investments at fair value, it will be covered under this standard. Now fair value also two things: FVT PL or FVT OCI. Can you please tell me, we will classify the investments at FVT OCI in what situation? Tell me. We'll classify investment in equity instruments of another company at FVT OCI in which situation? When it is held for long term and strategic reasons, and this is an irrevocable option. Don't worry, even if you are not able to recall, don't worry, we will be studying this in detail in the next class. Irrevocable option at initial recognition. Clear, everyone? Now accounting for lease receivable and lease liabilities. Understand, see here what I told. Lease contracts are out of purview, but lease receivables and lease liabilities, what I told in that class, it is covered under Ind AS 109. That's what I'm saying. Accounting for lease receivable and lease liabilities will be covered here. The initial accounting treatment is covered by Ind AS 116, but the subsequent accounting treatment of leases, receivables, or liabilities will be covered under financial instruments. See here. Subsequent accounting treatment as per Ind AS 109 for lease receivable, right? Now for similarly for lease liability also, just let me show it to you. See, subsequently lease liability will be measured at Ind AS 109. Clear everyone? Now examples of financial assets and financial liabilities. Trade receivable is a financial asset, right? Loans given is a financial asset. Investment in equity shares, preference shares, or debentures is a financial asset. Now tell me, PPE, intangible assets or investment property, is it a financial asset? No. Why? There is no contractual right to receive cash. Okay. Now advance given for supply of goods. I have given an advance. Is it a financial asset? No. Why? Because there is a contractual right, but to receive goods, not right. Good. Tax refundable. Tax refundable, statutory. Very good. Now, financial liabilities, trade payables, bank loan, redeemable preference shares, all these are financial liabilities. Tax liability, statutory. Income received in advance. I do have a contractual obligation, but to deliver the goods, right? As there is a contractual obligation to transfer the goods or services, hence it is not a financial liability. Clear everyone? Now, let's understand the classification of financial liability versus equity. Whenever there is a contractual obligation to pay cash, it will be financial liability, not equity. Whenever there is a contract that will be settled in entities' own equity instruments that are variable in number. Number is variable. I am not mentioning whether it is compulsorily or optionally. Liability. Don't see answer, huh? Now, see, this is a financial liability. Now, contract that will be settled in entities' own equity instruments, fixed in number. It is fixed in number, but there is an option to the instrument holder. Liability. Very good. Contract that will settle in entities' own equity instruments, variable in number, at option to instrument holder. Contract that will settle in entities' own equity instruments, compulsorily convertible and fixed in number. Equity. Wonderful. Now I think this answer is wrong. Okay. Clear everyone? These answers are wrong for your checkpoints. So that what happens, a student sometimes is studying and they sleeps off. So he should understand whether what mistake I have made. Financial liability. So now we have understood so far the meaning of financial liability, financial asset, and financial equity, and then we studied the applicability. Then we also understood the classification of the financial liability and equity. Okay. Now understand if it is a financial liability, how will we measure the same? Now, if it is a financial liability, it has to be measured at amortized cost, but there are certain exceptions. Exceptions are derivative liabilities, which are measured at. Very good. Financial guarantees are measured at FVTP, and accounting mismatch. When there is an asset liability mismatch, again in these three cases we'll measure financial liability at FVTPL. Very good. Clearly everyone the measurement. Now, if it is amortized cost method, how will we measure the same? Let's suppose I have taken a financial liability without transaction costs. The accounting for that will be very simple. There is no transaction cost involved. The accounting will be very simple. Whatever is the coupon rate, that itself becomes the effective interest rate, right? And we'll do the basically what we'll do, opening plus whatever is the interest plus pay the interest equals to closing financial liability. It's very simple. And I'll say strike it off. A question on this is not expected in the exam. Okay. Now comes to with transaction cost. What happens? And this what happens in practical life also. Whenever you take a loan, you have to pay processing fees, right? Or if you take from bank, if you take from any private player, you might have some issue cost. If you issue debentures, you might issue some issue cost. You might incur issue costs, right? So there will be a transaction cost involved whenever you take any financial liability. Now what happens? Understand, I have taken a loan of 1 lakh. okay, and I'll pay an interest of 10%, right? So ideally my finance cost should be 10,000 per year. But what happens, initially I have paid 5,000 as processing fees. Now, how should this processing fees be treated is my question. So now, why do I reduce in from the live loan? As you mentioned it rightly, that we will reduce it from the loan. Okay, I understand. I will record the loan at 95,000. Okay, fine. But why? No, 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 no. You will always pay interest on 1 lakh. Okay. Exactly. So what we are doing is, see, there are two options of accounting this one. Option number one, which we used to do in old accounting standards, like in the AS, was we used to record the loan at 1 lakh. We used to record 10% interest cost, and we used to amortize 5,000 over the loan in the ratio of outstanding loan amount. Right? That's what we should do in CA Foundation and CA Inter. But this process has changed. Why? Because what you have to do is you have to account for processing fees separately. Okay, and as you said that there might be a volume of loans. Okay, now for each loan, identifying the processing fees and amortizing it on the outstanding loan amount might be challenging. So what they did is, what is the net amount you have received? 95,000. Record the loan at 95,000. But this 5,000 is also a cost, right? So your cost is to take 1 lakh loan is not only 10%. Your cost is 10% plus 5,000. So what will be your effective interest rate is not 10%, it will be something more than 10%. Very good. So what we'll do, we will factor this 5,000 in this 10% interest rate, and we'll arrive at effective interest rate that will be somewhat higher than 10%, might be 12% or 13%. Okay, and we'll account for it in this manner. Clear, everyone? Now, so what we do, record financial liability at the net amount received, charge finance cost at effective interest rate. Okay, what is the meaning of effective interest rate? A rate where the inflow is equals to outflow. Okay, now and pay the contractual payments. Now, so what is the amortization schedule which will prepare? It will be opening liability plus finance costs at effective interest rate minus actual payments at contractual rate is equals to closing financial liability. Clear, everyone? Now, what is journal entry? Okay, first I'll say effective interest rate will ideally be given in the question. Okay, if not given, then I will also explain how exactly you have to calculate. Okay, interpolation method, right? You know. Okay, now journal entries. On the date when you receive the loan, bank account debit to financial liability, net amount. During the term of FL, finance cost account debit to financial liability to bank. If a question comes in the exam for passing the journal entries, guys, please, what student does in the exam, they try to merge these two entries. That's totally correct. Marks will not be rejected, but what will happen in the process to merge these two entries, you will make a mistake in the numbers. Okay, so please keep these two entries separate. Might be you will take extra 2 minutes, but this extra 2 minutes will be worth it because it will make your answer correct. Okay, so please pass these two entries separately. Finance cost will be at effective interest rate on the carrying amount. Okay, but this amount that I have to pay will be at coupon rate on the face value. Clear, everyone? Now let's take up a question. Very easy question. Can you solve it? And don't think a question like this cannot come in the exam, because this is an exam question. In the last batch itself, I took this question, but what happened? I didn't write this attempt. So similar question is given in your ICI study material also. Similar question, but the student was like, "Sir, this type of question will not come. Half yearly and quarterly will not come in the exam." So it is not the case that it can come. Though this question will require a lot of calculations, totally agree, but please solve it. interest to be charged and paid quarterly. So first what we will do, step 1, you will calculate the contractual cash outflows. Let's do it. I am writing whatever you will say, I'll write. Okay. Calculation of contractual cash flow. Okay. Year 1, quarter 1, quarter 2, quarter 3, quarter 4. Year 2, quarter 1, quarter 2, quarter 3 and quarter 4. Now what is the opening principal? 20,000? No, I'm talking about the principal now only, okay? I'm talking only about the principal. You have to calculate the contractual cash flows, okay? Opening principal is 20,000. Now, what is does it say? See, the loan is repayable in 4 half-yearly installments. So what I'll do is I'll pay 5,000 here, repayment of the principal. I'll write repayment of principal. I'll pay 5,000 here. I'll pay 5,000 here. I'll pay 5,000 here. I'll pay 5,000 here. Now, what is the closing balance? So it will be 20,000 only. Now, what is the finance costs? Contract interest payments. What is the interest rate? 12%, right? To be paid quarterly. So it will be 20,000 multiplied by 12% divided by 4 is 600. Now again here 20,000 minus 5,000 into 0.12 divided by 4 is, tell me how much? Loan is payable in half yearly installments. But here understand, tell me, right? So what will be the interest payment here? Interest payout, tell me. 450. 20,000 multiplied by 12% divided by 4, 600, right? Quarter 2, right? I have paid this 5,000 at the end of quarter 2. So it will be 600 only. So now it is 20, this is 20,000 minus 5,000 is 15,000. Now third quarter, see third quarter the opening balance becomes 15,000 now. So I have to pay at 15,000. 15,000 into 12% divided by 4 is 450. Third quarter is 450. Clear? Now, so this is 15,000 minus 15,000. Again 450 here. Very good. So this becomes 15,000 minus 5,000. It becomes 10,000. This 10,000 is opening here. Now opening 10,000 into 12% divided by 4 is 300. Now again 300. So it's 10,000 minus 5,000 is 5,000, right? So it's 5,000 is the opening balance. 5,000 into 0.12 divided by 4 is 150 and 150. Okay, 5,000 minus 5,000 is nil. So these are the total outflow is how much now? See, here it is 600, here it is 5,600, here it is 450, here it is 5450, here it is 300, here it is 5,300, here it is just a minute. It is 150 and here it is 5150. 1, 2, 3, 4, 5, 6, 7, 8. Just the alignment is different, okay? Otherwise you can manage. No, total I don't need. I need the quarterly payments, okay? Now, see, read the question again. So now you do have the contractual cash flows with you, okay? Now, understand. Effective interest rate is also given in the question. Can you please prepare amortization schedule? amortization schedule. Quarter 1, quarter 2, quarter 3, quarter 4. Again quarter 1, quarter 2, quarter 3, quarter 4. Here it is opening principal or opening financial liability, all right. Opening financial liability, then finance costs, then contractual payments, then closing financial liability. What is the opening financial liability? What is the opening financial liability? Tell me. 19,000. Who told 20,000? Anyone? For 20,000? Okay, 19,000. Because we record the financial liability at net amount. Okay, now finance cost at effective interest rate is how much? 16.6%. Tell me what is the finance cost? 19,000 into 0.166 divided by 4, 788.5. Contractual payment is how much for the first quarter? 600. Closing financial liability is how much? 19,000 plus 788.5 minus 600 is 19,188.50. Here it is 19,188.5. What is the finance cost again? 796.3. Okay, now payment is how much? 5,600, not 600. What is the closing financial liability? 19,188.5 plus 796.3 minus 5,600 is 14,384.8. Clear? Now can you please complete this table? I think this you can do. Or you want me to complete it? Okay, now, okay, assuming you will complete that, but now tell me a few things. This finance cost will go to where? P&L, very good. This contractual cash flow will go where? Liability. It's a cash flow, right? It will go to cash flow statement. Now, this closing financial liability will go where? Balance sheet as financial liability, and you will show it as current and non-current, which we have already studied in the last class. You already know how to do it, current and non-current classification. So now you understood the classification, the measurement as per amortized cost method. Is it clear, everyone? To understand this, whenever there is a transaction cost involved, the interest rate is factored in for the processing fees or any other transaction cost also, and the interest rate increases. In this increase in interest rate is called as effective interest rate. Now, do you know how to calculate effective interest rate, or do you want me to cover that as well? You know, so basically you will know that you need particular amount. Okay, let's suppose you need 10,000 as the present value you need. Okay, so you need this fine to rate. Okay, you can by hit and trial. Let's suppose you took 12%, you took 13%. Okay, you with 12% you got some amount, you with 13% you got some amount, right? Now applying interpolation, you have to find X percentage. That will be the interest rate implicit. Clear, everyone? Still, if anyone has any queries, please reach out to me. I'll help you out in that. Okay. Clear, everyone, so far? Now, compound financial instruments. What is the meaning of compound financial instruments? It has the features of equity and financial liability both. Now, how come a one instrument can have the quality or the features of financial liability and equity instrument both? Can you give an example? ESOPs are not covered here, na? That is also not covered here. Okay, then that becomes financial liability. Redeemable preference shares. Okay, if it is redeemable, it becomes financial liability. Always understand that whenever you analyze any instrument for classifying it as an equity or liability or a compound financial instrument, break the instrument into three parts: principal component, interest component, and if there is any other right, then analyze these three components separately. As you said, redeemable preference shares, that is the principal portion that will be redeemed, right? That is a financial liability. But you would have counted me, sir, the dividend part is an equity, because see, the company doesn't have any obligation to pay dividend on preference shares as well. Okay, if it is non-cumulative. Okay, so that is an equity component. So that redeemable preference shares has one liability component, has one equity component, becomes compound financial instrument. Okay, now compulsorily convertible, you can say debentures. Okay, debentures means interest. Interest is what? Obligation is there, financial liability, but compulsory convertible into fixed number, equity. So principal is equity. This becomes compound financial instrument, right? So always break a instrument into three parts this way. This is the chart to understand this one for a compound financial instrument. Those who have not taken the book, please draw this chart in your notebook. Okay, always break any instrument into three parts: principal, either interest or dividend, and third is conversion rights. Okay, whenever there is any conversion rights, it will always be equity. Why? Because these rights allow me or give me a right to convert the instrument to equity, so it will always be equity. Okay, no questioning on this one. Now coming to interest or dividend, for that the standard says if there is a contractual obligation, it will be financial liability. If no contractual obligation, it will be equity. Now understand, just when the name is interest, you cannot say it is a financial liability, or just if the name is dividend, you cannot say it's a equity. Okay, it can be the case the name is said as dividend, but it is the company is bound to pay that. Okay, or it can be the case that the name is interest, but the company is not bound to pay that. Okay, company can avoid the payment of interest. To just to give you one of the this one example, parent company gives a loan to the subsidiary company and says that you keep this loan, repay this loan up to me back after 5 years. Loan, it's a financial liability, right? But it says this interest you can pay me in the years when you are having a profit. In the years when you don't have profit, don't pay me the interest. So there is no contractual obligation in that case. Okay, so if there is no contractual obligation, even if it's an interest, it's a equity. Okay, so analyze the contractual obligation. See, that's what is the main, you can say the best part of India's 109. It doesn't depend upon the form, it depends upon the substance. Okay, the form might be the interest with the name, the form, it appears to be a financial liability. The dividend with the form, it appears to be equity, but it doesn't depend upon the form, it depends upon the substance, what exactly it is. Now coming to principle. When there is a contractual obligation to give cash, it is financial liability. But if there is a contractual obligation to give equity, then we have to analyze. It is compulsorily convertible, optionally convertible, or the question is silent. In multiple cases, you will find that the question is silent. Now, if it is compulsorily convertible, we say it is variable in number, financial liability. If it is fixed in number, it is equity. If it is optionally convertible, then we see if the holder has the option, means you do have the option. You as an instrument holder have an option. Can I control you? No. If you ask for cash, I have to give you cash. If you ask for equity, I have to give you equity. Means if someone asks me cash, being conservative, I'll say he has asked me cash, I have to give him cash. Means it's a contractual obligation which I cannot avoid, and hence it's a financial liability. But understand, if entity has the option, means me as an entity, I do have an option. Now I will do according to what suits me better, right? So if there is a fixed number, it will be equity. If others, it will be financial liability. Clear? Now, if the question is silent, what will you do? No. Understand? If the question is silent, you will see if the question writes the term may or will. Okay, first you have to find indicators. If it is may means optionally. If it is will means compulsorily. If the question doesn't say may or will as well, then you will assume that the holder has the option and it is a financial liability. Clear everyone? I believe using this chart you can convert any instrument, classify whether it is a financial liability or an equity or a compound financial instrument. If anyone is drawing this chart, please draw, let me know once it is done. I am waiting for 2 minutes. And if you have any queries, you can discuss that as well. Done? Done? Okay. Fair enough. Now, if we classify, once we say, okay, it is a compound financial instrument, okay, like let's suppose here it is a equity, okay, here it is a equity, here it is a financial liability. Now see, one instrument has principal portion is equity, interest portion is financial liability, and conversion right is again equity. So this instrument has what? Equity, liability, equity, compound financial instrument. Now, once we classify, okay, the instrument is a compound financial instrument, then comes the question, how will I do the accounting for that? How will I do the accounting for that? So step 1, the accounting treatment. Now tell me when I will do this accounting treatment. It is to be done on the date of the issue of the instrument, not the date of the settlement of the instrument. Okay, I'll write here something. Settlement date. No, not on settlement date, on the date when the instrument is issued. Okay, now what I will do, step 1, identify FL and equity component, which you are doing here. Then once you identified, okay, this is my equity component, this is my financial liability component. Financial liability component means contractual obligation. Contractual obligation for contractual cash outflows. So what will you do? Calculate the present value of the contractual cash flows. Using what rate? No, not interest rate, not effective interest rate. Think of, come here. Now listen here, listen. What happens? Reliance took a loan from bank at the rate of 10%. Okay. Now again Reliance, again bank took a loan of 1 crore, but Reliance told that I will give you interest definitely, but Mukesh Bhai Ambani thought that I have to reduce the interest rate now. What to do? So he told to the bank that I am giving you the right to convert this loan to equity. At the end of the term, I am giving you a right to convert this loan to equity. I am giving him conversion rights. Now definitely the bank will be attracted to this offer, and what he will do, he will reduce the interest rate. Interest rate will reduce, let's suppose 8%. Why 8%? This 2% denotes the value of the conversion right. Very good. Now, if I am calculating the pure financial liability in step 2, what I am doing? I am calculating the pure financial liability. Right? What is the interest rate for pure financial liability? 10%. So at what rate I will calculate the present value? See, using the market rate of interest for similar instruments without conversion rights. See, both of the instruments are similar, right? But this doesn't have any conversion rights. Why? Because I am calculating the value of financial liability. So take the rate of financial liability. 8% is the rate of financial liability factored in for conversion rights. But I am calculating the pure financial liability element now. So to calculate the pure financial liability element, take the rate of pure financial liability element. Okay. Now the differential, the equity is what? The residual portion. So what I'll do, issue proceeds minus financial liability is your equity. So this is how you will bifurcate the issue proceeds to financial liability and equity instrument. Is it clear, everyone? And this process is called as split accounting. Many times a question will say split accounting in the exam. I'll show this. Come here. See. See how many times split accounting has come in the exam. Convertible loan is a split accounting. Okay. 1, 2, 3, 4, 5, 6, 7. I hope so. So understood, no? Understood the importance and you have understood the concept. Both clear? Good. Now, subsequently, what I'll do? See, on the date when the instrument was issued, I classified the instrument as equity and financial liability. Subsequently, equity will remain at cost as it is, will not touch the equity. But financial liability, what will do? Amortized cost, right? That is charge finance cost and record contractual payments. Now, when you will charge finance cost at what rate? Finance cost at what rate? And what is EIR here? The discount rate which you used. The discount rate which you used to calculate the present value is becomes the EIR now. Okay, 10%. Right? Now, on settlement date, what will you do? If it is compulsorily convertible, either equity or financial liability, whatever it is, to equity capital or to securities premium. If it is optionally convertible, then I will try to either bank or equity capital to securities premium. Okay, clear everyone? Let's solve a question on this one. Again, this is an exam question. If you can solve this question, I believe you can solve any question pertaining to compound financial instrument. Yes, please. Cannot do beyond this. Come and sit here now. Is the question clear, everyone? Or still reading? I don't know why we start auditing the question itself. I know we are chartered accountants, so we have to do audit. Let's discuss this question now. Five years, right? on this date, it says that we have issued Perfect Limited issued 50,000 compulsorily convertible, cumulatively convertible preference shares. Okay. Now as on 1st April 2017 at 180 each. Convertible into 12,500 equity shares, fixed number of equity shares. Okay, fine. Face value is this much. Okay, fine. At the company at the end of 5th year from the date of allotment. So this is settlement date. Okay, now when the CCPS are issued, the prevailing market interest rate for similar debt without conversion option is 15%. Okay, so it says the market rate for the similar debt without conversion option is 15% per annum. It says the transaction cost further is 2% of the value of the proceeds. Effective interest rate is 15.86%. Now, what is your requirement? What is the requirement? See, you are required to compute the value of liability and equity and pass journal entries for the entire term of the arrangement from the issue of the preference shares till the conversion to equity shares. So, for all these 5 years, you have to pass the journal entry. Very good. So basically, it covers everything. It covers the transaction cost. It covers the treatment of amortized cost method. It covers the component of this one effective interest rate. It covers the accounting during the term. It covers the settlement date accounting. So it covers each and everything. For how many marks? 12 marks. So easy scoring 12 marks. Now, first let's do the accounting on the date of issue of the instrument. On date of issue. Who has to go to the exam? Me or you? I have to go to the exam? You. So who will solve in the exam? I'll come. You then solve here also. Step 1 is identify whether it is equity or financial liability. Now, let's identify. It is CCCPS. Conversion right is always equity. Now, principal here is what? Compulsorily convertible into fixed number of equity shares. So it becomes what? Equity. Now, the dividend is what? See what is said about dividend? Cumulative means I have to pay mandatorily, meaning thereby it is contractual obligation exists and it becomes my financial liability. Now, so what is my contractual cash flows for the next 5 years? 1, 2, 3, 4 and 5. Contractual cash flows. Tell me what is the amount? 50,000 and what is the face value? 10. That is for this one, not this one. Just a minute. Isn't it given? No. So it is not given. 100 rupees is given in the question. So we'll consider 180 itself. And what is the interest rate? Where is it given? 10%? 10%. Okay, fine. That is 10%. So what does it become? 50,000 multiplied by 180 multiplied by 0.1 is 9 lakh per annum. Is your contractual cash flows. Can you please calculate the present value at what rate? 15%. 15 point? Why 15.86? But will we calculate the present value using 15.86 or 15? 15, good. Please tell me what is the present value. You can use these rates. Discount rate is given already. So what will you do? You will just multiply, add it off. 0.8696 plus 0.7561. Can you please add it and tell me what is the amount total present value? Total present value. In the exam, if this discounting rate is not given, which function of the calculator you are going to use? GT, very good. 30 lakh 16,890. Okay. This is your financial liability. Clear? Now the question also says that there is a transaction cost involved. What is the amount of transaction cost? Tell me. 2% of issue proceeds. And what is the issue proceeds? 50,000 multiplied by 180 multiplied by 2% is how much? 1,80,000. Now coming to step number 3 is finding equity component. Equity was how much? Issue proceeds minus financial liability. I can guarantee that many of you are going to make mistake here. Tell me, what is the issue proceeds? Wonderful answer. Tell me, 8820. Now minus financial liability is how much? 30 16,890. So what is equity? Tell me. Pardon? 110. Now don't you think you have allocated the full transaction cost to equity? Right? But that is wrong. If there is a transaction cost for a particular instrument and the instrument has the features for equity and liability both, then the transaction cost has also to be allocated to the both. So always remember, that's a mistake area. Whenever there is a transaction cost, do not factor in transaction cost here. Take here how much? 90 lakhs. And find out the value of equity now. Tell me, what is the value of equity? $59,83,110. Now you have found the value of equity, you have found the value of liability, but there is a transaction cost. So what will you do? You will allocate the transaction costs to equity and financial liability in the ratio of their carrying amount. So what was the transaction cost? Tell me. 180,000. Equity is 5983,110 divided by 90 lakhs. Now financial liability is 180,000 multiplied by 30,16,890 divided by 90 lakhs. Can you please tell me what is the amount allocated to equity and what is the amount allocated to financial liability? 1,19,000. Okay. 662. And how about this one? Financial liability? 16,000. 338. Okay, fine. Now this is how you have to allocate the equity and financial liability. Now understand, in general cases, if this transaction cost was not there, okay, we would have unwinded the financial liability using the same discount rate 15%. But now see, we calculate the present value of financial liability, that is 30,16890, using 15%. But from this I will subtract this transaction cost also. But then can we unwind using 15% now? No. Why? Because there is 60,338 allocated to transaction to financial liability again. So your transaction interest rate will be something more than 15%, which will be called as effective interest rate, which is how much? 15.86 given in the question. Now how will we do the accounting? Just a minute. on the date of issue of instrument, I will pass journal entry what? Bank account debit to financial liability to equity 88,000 lakh 20,000. Now this one will be how much? Tell me. Equity will be 3016,890 is financial liability minus financial liability 60338 is 2956552 is 2956552 and equity will be how much? 58 63 440 448. Okay, fine. Is it clear now? The date of issue? Now 5 years, right? 1, 2, 3. Okay, we do have space. So then, is it visible to all of you? One, two, three, four, 5. Now, equity will remain constant in the first year, second year, third year, fourth year, fifth year. Now, financial liability, what will we do? So, what is the value of equity here? Equity will be same 5863 448. Can you please calculate and tell me what is the value of financial liability here? Unwind the value at the rate of 15.86 percentage. I will write also. Unwind at 15.86 percentage, that is effective interest rate. Tell me value of financial liability at the end of year 5. At the end of year 5. Year end 5. Contractual cash flows are 9 lakh per annum. 2956552 into 1.156. Financial liability was pertaining to what? Interest components, right? Don't you think interest component would have settled during the term of the loan itself? So will we have any balance? Ideally no, but please calculate and check. That will be a check on the numbers that we have taken. Pardon? Rounding off error. Done? What is the value of financial liability? Nil. How much? That is rounding off. Nil. So now what is the value of instrument? It is 58, 63, 448. Now I have to settle this instrument. How will I settle? By issue of equity instruments. How many equity shares? 12,005 shares. So I'll write equity account debit 5863,448 to equity share capital, how much? 12,500 multiplied by face value was 10. So it is, now what is the differential? $57, 38, 448. Is it clear now? Assessing the importance of this topic, is it clear now? So I have chosen this question because it had everything in it. Okay. Generally, when a question comes on compound financial instruments, they will ideally ask you to split. They will ideally ask you to show the entry on settlement date, but not everything in one question. Okay. Generally, no, but yes, if it asks, you are ready for that now. Everyone, is it clear? Any queries so far? Pardon? Yes. Why? If you will go to Ind AS 32, it says whenever do you have any transaction cost, whether interest, dividend, or any other transaction cost pertaining to equity, it will always be adjusted with equity. Okay. Any cost with pertaining to financial asset or a financial liability will be transferred to P&L always. Okay. But now this transaction cost for financial liability, what do? We transfer to P&L, but not directly, but by way of interest cost. Okay, that's the reason why we increase the interest cost and we calculate effective interest rate. Okay, but understand, no, okay, think of it from a point of view of earlier regime. If you have issued any equity shares and you incur some cost to issue the equity, where do you transfer that cost? You adjusted with securities premium, right? Ideally, securities premium is also a part of equity. So that's what we are doing. If I am incurring any cost to issue equity, that cost will also be adjusted with equity. Clear now? Anyone having any queries? No? So that's all for the day today. In the next class, we will be studying the rest topics for financial instruments and we will be completing the financial instruments tomorrow. For the next 2 classes will be remaining. In those 2 classes, we will be studying business combination and consolidation. Okay? But please revise and come. If you have any queries, do accumulate it and come. Okay? Thank you. Let's resume. So in the last class we were discussing about financial instruments, and today, as we planned, we will complete the financial instruments chapter, and from the next class we will start business combination and consolidation. Okay. So very good morning to all of you. Now, in the last class, just have a quick recap of what we studied about financial instruments. In the financial instruments, first we discussed about the meaning of the financial assets, financial liabilities, and the equity. Very good. Now, financial liabilities means what? A contractual obligation to pay in cash or, very good. So there should be a contractual, there should be an obligation. Okay. Now, what is the meaning of financial asset? Contractual right to receive. Very good. And what is the meaning of equity? Residual interest. Very good. Now, whenever there is a contractual right or a contractual obligation to receive or deliver something in a potentially favorable or unfavorable condition, that becomes what? Derivative assets or derivative liabilities, right? So now that's what we studied again. So if it's a potentially favorable condition for us, it becomes derivative assets. If it's potentially unfavorable condition, it becomes derivative liabilities. Very good. Now, third point that we studied was contract that will or may be settled in entity's own equity shares. Very good. Now, will means compulsorily convertible. May means optionally convertible. Now, if it is variable in number, then it becomes financial liability. If it is optionally convertible, it becomes financial liability, whether variable in number or fixed in number. If it is compulsorily convertible, then compulsory convertible and fixed in number, equity. Very good. Compulsory convertible and variable in number, liability. Very good. So that's the meaning of a financial assets, financial liabilities, and equity. Wonderful. Now, after discussing the meaning, we discussed about the applicability, and I believe it's clear to everyone. Now, further, we discussed about financial liability, right? We discussed financial liability has to be measured at amortized cost method, but there are 3 exceptions. Can you tell me what are the 3 exceptions? Financial guarantee, derivative liability, and one more, accounting mismatch. right? Whenever there is an accounting mismatch. So in these three cases, we measure at FBT, P&L. Okay. Now, whenever we have to measure the financial liability at amortized cost method, what we do, we record the liability at its cost, whatever amount we have received basically. Then further, we record the finance cost at its effective interest rate. Right now, effective interest rate will be equal to the coupon rate if there is no transaction cost. If there is a transaction cost, then the coupon rate will be increased or will be factored for the transaction cost, which will become the effective interest rate. Effective interest rate, how will we calculate? At a rate where the inflows equals to outflows. Generally, effective interest rate will be given in the question. If not, you know to calculate by using interpolation. Okay, fair enough. Now that's all about financial liabilities. Now further, what will you do is in financial liabilities, whenever you have to calculate the contractual payments, you will multiply coupon rate with on the face value. But whenever you have to calculate finance cost, you will multiply effective interest rate on the carrying amount. Okay, clear? Everyone clear? Now then we discussed about compound financial instruments. In compound financial instruments, we discussed that first step we have to identify which one is a equity, which one is a liability. And to identify that, we told that for any instrument, divide into three parts: principal, interest, dividend, or conversion rights. Very good. Principal has to be assessed contractual obligation to pay cash, financial liability. To give equity, then assess compulsorily, optionally, or the question is silent. If it is compulsorily, then fixed in number, equity; variable in number, liability; optionally convertible, all the cases, liability. But if the option is with the entity, then we have to assess entity, what is beneficial for the entity, okay? And fixed in number, then equity, otherwise financial liability. If the question is silent, we'll assume that it is the optionally convertible and the option is with the holder and it is financial liability. Very good. Now then come to interest or dividend component. If a contractual obligation exists, financial liability, otherwise equity. Conversion rights will always be equity. Very good. Now step 1 clear, identify financial liability and equity. Now after identifying this, for the financial liability component, identify what are the contractual cash flows. Calculate the present value of that using what rate? Market rate of similar instruments without conversion rights. Remember Mukesh Bhai's story, right? If he wants to go to the bank for taking a loan, he will get at 10%. But if he gives equity rights, 8%. Very good. Now, so that's the story of Mukesh Bhai Ambani. Okay, now third one comes after calculating the present value, it will give me the value of financial liability. Now, what is the meaning of equity? The residual portion. So, whatever money I have got, from which I will deduct financial liability, whatever is the residual portion will be my equity. Very good. Now, if a transaction cost component is there in the instrument, will I factor in transaction cost and then calculate the equity? No. Ignore transaction cost, calculate equity and the financial liability first, then allocate this transaction cost to equity and to financial liability. Subsequently, equity will remain at its cost itself. Financial liability we will unwind. If there is no transaction cost, we will unwind at the same discount rate which we used to calculate the present value. But if there is a transaction cost involved, we will take effective interest rate. Okay. On the settlement date, we will settle the transaction. Okay. If we have to pay cash, we will pay cash. If we have to settle by use of equity shares, we will issue equity shares, and any differential will be transferred to securities premium. Clear, everyone till here? Now, starting the today's class from now. So next topic which we have to study is redemption of compound financial instrument. See, so far we studied about if a compound instrument has to be issued, on the date of issue of the compound instrument, how will we do the split accounting, subsequently how will we do the accounting, and on the date of settlement, how will we do the accounting. Now comes the question, if during the term of compound financial instrument, this instrument gets redeemed, okay, or we prepay the option, okay, prepay this instrument, then how will that be settled? Now see, so standard says that first, calculate the carrying amount of financial liability and the equity on the date of such redemption. Okay, first calculate the carrying amount. Now, when you are redeeming it now, understand why will any company try to redeem a financial liability or a compound financial instrument? Tell me why. Think that you are a company. Think that you are a company. Now you have a compound financial instrument. Basically, you have the Reliance has issued a convertible debentures to its public, okay, at the rate of 10%. Now, definitely Reliance will need the funds. Why will Reliance try to redeem it?
They have more favorable terms.
Pardon?
They they can get the loan at more favorable terms.
Exactly. Now Reliance thinks that this loan is being issued at 10%. I have to give interest of 10% every year. If I issue a new instrument now, I be able to issue at 8% itself, right? So what Reliance will think, let's redeem it off now and issue a new instrument, right? So what I'll do is I will calculate the revised fair value of this instrument now. I will calculate the revised fair value of this instrument now. Okay. Now after calculating the revised fair value, I will see what is the revised fair value. Now when I'm redeeming it, I will redeem at some value. So there are three values now: carrying amount of the financial liability, revised fair value of the financial liability, and the payment amount. How will we deal with that? Understand? Standard says when carrying amount of financial liability and the revised amount of financial liability. How will we calculate the revised amount of financial liability? It says it's the present value. It's the present value of the contractual cash flows, the remaining contractual cash flows at revised market rate. At revised market rate. Okay. This is the revised amount of financial liability. Now tell me, so far whenever we discussed about financial liability, did I tell you at any given point of time that you guys have to revalue the financial liability? No. Why? Because always our intent was to take the financial liability till the date of settlement. Nowhere so far we told that, or we discussed that the financial liability has to be settled between, right? But it is here we are settling the financial liability in between, right? So if you are settling it, we need to know what is the value of this financial liability as of today. Okay, because see, understand, whenever you are settling any transaction, might be any asset, might be any liability, whatever it is, okay, on the date of settlement, to determine what should be the price at which I'll settle, you need to know what is the value of it, right? So that's the reason you calculate the value of it here. Okay. Now standard says here that the difference between the carrying amount and the revised fair value of the financial liability will be transferred to P&L as a gain or loss on remeasurement. But the difference between the revised fair value and the amount paid will be adjusted with the equity. Okay. How exactly? Let's take up an example and try to solve it. Again, this is an exam question. Okay. Now, let's try to solve it. Please read the question. And everyone have to solve it. On 1st April 2014, Shelter Limited issued 5,008% convertible debentures. Convertible debentures means compound financial instruments, right? With a face value of rupee 100 each, maturing on 31st March 2019. Means how many years? 5, 15, 16, 17, 18, 19. 5 years. Right? The debentures are convertible into equity shares of Shelter Limited at a conversion price of 105 per share. Okay. Now the interest is payable annually in cash. At the date of issue, the Shelter Limited could have issued non-convertible debt. Now what it is? See here. Could have issued a non-convertible debt with a 5-year term, coupon bearing of 12%. Means this is non-convertible, right? And the instrument which I have issued is convertible. So it says this will become the discount rate. Very good. This will become the discount rate of 12%. On 1st April 2017, the convertible debentures have a fair value of 525,000. Okay. The Shelter Limited makes a tender offer to the debenture holders to repurchase the debentures for this much amount, which the holders accepted. At the date of repurchase, Shelter could have issued non-convertible debt at a 2-year term bearing a coupon interest rate of 9%. Now understand this one. Let's try to solve this question. What is required in the question? So accounting entries in the books of Shelter Limited for recording the equity and the financial liability component at the time of initial recognition. Now it says first on the date of issue. On the date of issue of instrument, you have to do split accounting. Can you please split the instrument into equity and liability and tell me the amount? Come on, guys. in this question, just make an write an assumption, right? Just one write anything. The principal is financial liability. Okay, just write this one. Now try to solve this one. Pardon, just let me calculate it. What is the year contractual cash flows present value at the rate of what rate? 12%. Now 1, 2, 3, 4, 5. What are the contractual cash flows? Tell me. 5,000. The face value is 100 is 5 lakh. 5 lakh multiplied by 8% is 40,000. So okay. Now can you please calculate the present value? $427,700. Okay, this is the value of your financial liability. Now what is the issue proceeds? See, I assume there are no transaction cost, right? No. So what is the issue proceeds? 5 lakh, right? So what is your equity? What is the value of equity? Pardon? 17? 70. 72,300. Clear everyone so far? Okay, now subsequently read the question further. On what date I am trying to redeem it? On what date? 1st April 2017. And after how many years? 3 years. Okay. Now that is, now calculate on 1st April 2017. On 1st April 2017, tell me what is the carrying amount of financial liability and equity instrument. Tell me. What is the carrying amount of financial liability and equity after 3 years? So it is 427700 multiplied by 1.12 minus 40,000 is 15. What is the value? Tell me. Four two seven seven double zero multiplied by 1.12 minus 40,000. 4,65,911. Clear everyone so far? Okay. Now let's try to make this line chart. What is the carrying amount of financial liability? 465,911, right? Now on this date, we are doing on which date? See here, on 1st April 2017. Now what you have to do here is you have to calculate, that is on this date, on 1st April 2017, what is the revised value of financial liability. Now how will you calculate that? Tell me the calculate the contractual cash flows, year contractual cash flows. So what are, how many years are remaining? Tell me. 2 years are remaining. Okay, fine. So 1, 2, 40,000. and 40,000 plus 5 lakhs. Now present value we will calculate at what rate? Just see here. It says at the date of repurchase, the Shelter Limited could have issued the non-convertible debt for a 2-year term bearing a coupon interest rate of 9%. So I will calculate here at 9%. That is, the interest rate have reduced or increased? Reduced, right? See, from 12% decreased to 9%, right? It is reduced. Please, can you calculate the present value? What is the present value, guys? Come on. 491, 360. Is it clear? Everyone clear? 360, right? Now let's write here. Revised carrying amount, revised value is how much? 491, 360, right? Now on this date, understand the logic. I'm explaining the logic here. Come on. On this date, you are saying, as per the revised term, the value of a financial liability is 491,360, right? And what is the proceeds that you will be getting to settle this transaction? 525. Listen to me very carefully here, okay? This is the logic. Proceeds which you will be getting here is 525,000, right? So what is the residual portion? Can you tell me what is the amount? 30? 33640. I am very bad at maths. Okay. Now, so now tell me, just see here, settlement amount is 525,000. And tell me initially what I told, this amount will go where? Equity. Now, why equity? See here, this is the reason why equity. Because the residual portion always goes where? Equity. See, this is your fair value. This is, see, now link here. This is the value 491,360. This is the value here, right? This is the settlement amount here. The difference 33,640 always goes to equity, right? So that's the reason why we transfer here this amount to equity, right? Now here what I am doing is I am remeasuring my financial liability from, I am saying that carrying amount of my financial liability is 465, but as per the revised terms, my fair value of the financial liability is 491,360, right? So this is a gain or loss on remeasurement of the financial liability. Hence, it will go to P and L. Clear, everyone? Okay. Now, what is the amount? Tell me. 25,449. Is it clear, or you want me to show the ledger? I can show the ledger so that it becomes a complete understanding. Okay, let me show the ledger also. I am preparing the ledger, but I want you guys also prepare the ledger along with me. Please, everyone. Or at least help me in this one preparing. Okay, now tell me, it's a financial liability ledger I'm preparing. Okay, financial liability account. Now tell me, what will I do initially? On 1st April 14, I will write what? By a bank. How much? 5 lakhs? No, not correct. Because the rest will be equity. 427,700, right? Now again, by finance cost, how much? Tell me, guys, come on. 31st March 15, by finance cost, how much? At the rate of 12%, if I'm not wrong. Come on, fastly. Then again, 31st March 15, I will write here to bank, how much? 40,000. Then to balance C by D, Come on, guys. Firstly, tell me the finance cost. 31,000? 324. What is the closing balance? 43? 439,024. Okay. Now again coming to 1st April 15 by B by D. How much? 439,024. Then again by finance costs at the rate of 12% is how much? 52,683. Now again to bank 40,000. To C by D how much? 4,51,706. Now okay, this is 31st March 16. Now again 1st April 16. Again B by D is how much? 451,706. Then what is the amount of finance costs? 54,205. Now tell me how much amount will we pay in the bank? 40,000. Now stop here. Stop here. Tell me what is the carrying amount. Considering all these things, tell me what is the carrying amount. 4,60,911. Now write here with a red pen. Definitely I am going to settle this transaction to bank 525. Everything cleared. But now this account will not get tallied. Right? So what will I have to do? Tell me. Very good. Now I will write here with red pen by P and L by equity adjustment. How much in P and L? 244 something you told? 25449. $25449 will be adjusted in P and L, that is remeasurement gain or loss. Okay. Remeasurement gain or loss, and equity is the remaining, that is 33640. Just see if the account is getting tallied or not. Is getting tallied? Now is the understanding clear, everyone? Okay. Now what will happen in equity account? I'll show that as well. Okay. In equity account, what will happen? Tell me again. By balance B by D 72300. Okay. Now this is on 1st April 14, right? Now it will be carried forward. I'm writing the same balance on 1st April 17, right? B by D, I'll write here 72,300, right? Rather it will not be B by D, it will be bank here. B by D 72,300, right? Now what is the adjustment that we have done? Tell me. FL, how much? 33640. What will be the about the rest? What about the rest? It will be transferred to retained earnings or any other reserves. What is the amount? 38,660. This is how this amount will be settled. Clear now? Anyone having any queries in this one now? Okay. See what happens whenever we create equity. Either we have to issue equity shares from that. If we don't issue equity shares from that, what will we do in that? Transfer to retained earnings, right? Now tell me, we created equity initially. Okay. Did we issue equity shares? No. Equity is a part of the other components of equity. So send it where it belongs to, other components of equity. Okay. Now, is this concept clear, everyone? Good. This is an important concept, I feel. Okay, can come in the exam. Not tell me.
72,300 is there, some portion of it we are transferring to financial liability. 33,600. So what is the reason?
I don't know. See here, this one. This is the amount, 33640. Sure. See, understand. On the date when we are redeeming this instrument, okay, we calculated again the fair value of this instrument, which came to how much? 491,360. Clear? Now I am saying that I am redeeming this instrument at 525. What is the residual portion? 33640. And where does the residual portion get adjusted? Equity, right? Because at the time of initial recognition also I did the same thing. This was the value of my financial liability. This is the amount that I received, right? So remaining goes to equity. Same thing happening here also. This is the value of the financial liability. This is the value that I will pay back. This is the value which will be adjusted to equity, right? So that's the reason why I am saying it here. See that diagram here now. On the date of redemption, you will have three data: the carrying amount of the financial liability, the revised carrying amount of the financial liability, which will be present value of the contractual cash flows using the revised market rate, okay, and the amount that which you pay to settle the transaction. So the difference between these two will go to P&L as a gain or loss on remeasurement. The difference between these two will be adjusted with equity. Okay, is that clear now? Journal entry I have already given here, but yes, I have shown you the ledger, so I believe it's clear to everyone. Okay, because I believe the ledger makes much more sense in understanding a concept. Okay, so now we have understood and cleared the concept of financial liability, compound financial instrument, and the redemption of the compound financial instrument as well. Any queries, anyone so far, whether from the previous class of financial instruments or whatever we discussed till today? Anyone? Come on, guys. How can there be no queries? Okay, fine. Now, coming to the next topic, that is financial assets. Unlike financial liabilities, okay, financial liabilities was very simple, very sorted, okay. So it like only amortized cost method. There was no challenge itself. But financial liability assets are very challenging. Again, though it's very easy as compared to financial liability, I'll say, but it's classification issues there here, okay, because financial assets can be measured at amortized cost, can be measured at FBT P&L, or can be measured at OCI. Why there is a difference between financial assets and financial liabilities? Because when I have a financial liability, I will definitely settle the transaction, but when I have a financial asset, that's an investment. Now the intent behind the investment that I am doing can be different, the intent behind the investment that you are doing can be different, and the intent behind three investments that you have done can be different for all the investments, right? So the investments or the financial assets has to be measured according to the intent or the nature of the instrument. Okay, now, so the three classifications can be amortized cost method, fair value through P&L, and fair value through OCI. Understand now? How will we classify a financial instrument at whether it is at basically, see, understand, can I say ad hoc basis, this financial asset, let's classify under amortized cost method, this financial asset, let's classify under FBT. Can I do that? No. There is a proper basis for that. How to do that? There are two tests. One is the business model test, another is contractual cash flow test. Okay. Now, what does business model test? See, both these tests have their own perspectives. Business model test, please understand here clearly, business model test assesses the instrument from the point of view of intention of holder of the instrument. Contractual cash flow test assesses from the nature of instrument. Now, when I purchase any instrument, my intent can be I will hold it till maturity. My intent can be I will held it for trading purposes, okay, or my intent can be I will hold it till maturity, but definitely if I get some exceptional returns or better returns, I will sell it off. Okay, so there can be three possible intent. Okay, hold till maturity, second hold till maturity and can be sold by if better returns are available, and third is held for trading. Okay, now contractual cash flow test, it says that we have to assess if the instrument, from the instrument I am getting principal and interest on specified dates and no other rights. So contractual cash flow test means four things: principal, interest on specified dates and no other rights. Now tell me, convertible bank loan. Okay, bank has given a loan to Mukesh Bhai, convertible loan. Okay, principal and interest has to be paid on specified dates. Will that classify contractual cash flow test? Why? Convertible, that gives a conversion right. Okay, so convertible instruments will never classify contractual cash flow test. Clear everyone? That's a mistake that a student does in the exam. He says, sir, in convertible bank loan, it's a principal interest on specified dates. It satisfies contractual cash flow test. No, it should not have any other right. It should not have any other right. Okay, clear everyone? Now, a simple crux for classifying. If business model test A, that is hold till maturity, and CCFT passes, you have to account for it as amortized cost method. Understand the nature. I am a bank, I have given you a loan. Okay, you will give me you will basically give me principal. Basically principal will be there, interest will be there. Agree? Now on specified dates, no other rights, and now you hold the instrument till maturity. Okay, or basically if I am the holder of the instrument, for me it's a financial asset, for you it's a financial liability. I want to hold this instrument till the end of the life of the instrument. Now see, it classifies hold till maturity, it classifies contractual cash flow test. That's what was happening for financial liability also, right? So in financial liability, what procedure we followed? Amortized cost method. Same we'll follow here also. Okay, but now I have given a loan to you. That's a financial asset for me. Okay, principal and interest on specified dates, fine. But what happens? My intent is, though I will hold this loan till maturity, but if I get some exceptional returns from this one, okay, let's suppose that I've given you a loan of 1 lakh, okay, but someone says that sell this loan to me and I'll give you 1,50,000. I know this, I will definitely not be able to realize 1,50,000 from you. Okay, so what I'll do, I will sell it off to him, right? But though initially my intent was not to sell, okay, but yes, it was like if I'm getting some better returns, I will sell it off, and now I'm getting some better returns, so I can sell it off. So in these cases, you have to follow fair value through OCI. Now why OCI? Why not P&L? Understand. If you have any instrument, which you don't want to sell, will you okay, or take the example like this. You purchase this calculator, okay, the life of this calculator is 5 years, okay, you have purchased this for your use, you don't want to sell it off. Now you purchase for 400, the price of this calculator decreases in the market, will you be affected? No. If the price of it increases, will you be affected? No. Or will say, sir, the price increased, I will record a profit in my P&L. No, because it doesn't matter to you, you don't want to sell it off, right? Now similar thing here in amortized cost method. What is happening is, I have taken an instrument which I want to hold till maturity. So whatever is the fair value gain or loss doesn't matter to me, I will not account for that, right? Now coming to second point, FBT OCI. Here also I want to hold till maturity, right? I want to hold till maturity. So ideally fair value gain or loss should not matter to me, right? But I say that I can sell it off. I can sell it off, right? Now for just for disclosure purposes, I want to show to my investor that if at all I sell in the future, what will be the gain or loss, right? So if I have to just give a disclosure, will I recognize gain or loss in the P&L? No, but I want to disclose it. So how will I disclose? So that's the reason I take it to OCI and not to P&L, right? Because I know that in the rarest of situation or in the possible situation in the future, might be I can sell, but generally I will not sell. Okay, so that's the reason I don't want to recognize the gain or loss to P&L, but yes, I want to disclose the gain or loss to the investor, and hence I recognize in OCI. Clear everyone? But now third one, that is any others, means any others can be held for trading purposes or contractual cash flow test doesn't pass. Okay, it can be anything. Now let's suppose I have purchased an investment in the shares of Reliance, okay, which I have held for trading purposes, which I know that I will definitely sell it off. Or let's take the recent example. I purchased the shares of Adani. Okay, I thought the shares price has decreased significantly. Let's purchase it off. Okay, for trading. When will it increase? I will sell it off. It's for trading, right? So whatever is the gain or loss that I will have that is happening every day, I will definitely record in my P&L, right? Because that's an actual gain or loss which I will book in some time. Okay, so that's the reason. So it says whenever there is any others, record in the P&L. Clear everyone? Now let's assess few instruments, whether what is should be the classification of this one. Trade receivables. Tell me, in trade receivables there is no interest ideally. Principal I know on which date I am going to receive, right? Because that's already specified as the credit terms. Now definitely I want to issue this hold this instrument till maturity, right? I have written here already the intention to hold. So if it is to hold, definitely BMT test gets passed, CFT gets passed because there is no other rights, so it comes under amortized cost method. Investment in debentures. Now whenever it is a debenture, principal and interest on specified dates and no other rights, assuming the interest intention is to hold. So again the BMT test gets passed, CCFT passes, again amortized cost. Investment in debentures, same, PI specified dates, no other rights. So CCFT pass. BMT is to sell if better returns are available, A or B? B. Now what it will be the classification? FBT, OCI. Clear everyone? Now investment in convertible debentures. Tell me, CCFT pass or fail? Fail. CCFT fail. Why? Conversion rights. Now BMT, let's suppose BMT is to hold. BMT is to hold. Now what will be the classification? FBT, P&L. Doesn't matter what is the intention now, right? CCFT fails. Investment in equity shares. How many for amortized cost? Okay, very good. Tell me, investment in equity shares. Do you get dividend on specified dates? Let's purchase the shares of Reliance and tell me the dates on which you will get the dividend for the next 5 years. Do you know that? So there is no specified date. CCFT fails. Now, if CCFT fails, there is no need to assess BMT, right? Comes to FBT, P&L, no amortized cost, right? Investment in equity shares can be measured at cost in only one situation. Can you tell me which situation? Investment in equity shares can be measured at cost in one situation. Subsidiary, associates, joint ventures, Ind AS 27, right? So if you go as per Ind AS 109, it has to be measured at fair value through P&L, that is a default classification. Subsequently, we'll also study that investment in equity shares can be measured at FBT OCI as well, right? But if the investment is in the subsidiary, associates, joint ventures, it can be measured at cost. There is an option given to the entity, right, as per Ind AS 27. Now understand, it says about equity shares, that investment in equity shares is classified at FBT P&L, that is a default classification, right? But it says there is an irrevocable option at initial recognition to classify the same at FBT OCI if it is held for long term and strategic reasons. Now comes the question, why irrevocable option? Understand, investment in equity shares is something wherein you can see a volatility, right? A gain or loss. So what happens, in the year of gain, they will say I will take it to P&L. In the year of loss, they will say I will take it to OCI, right? So it says you want to take it to OCI, you can take it off, no worries in that. But you have to decide when you are purchasing this instrument, okay? Once you have decided that you want to take it to OCI, you cannot take it back to P&L in any situation, okay? See, whenever you classify any financial asset at FBT OCI, at the time of settlement, you transfer all the OCI to P&L, you recycle to P&L. But in this situation, it is not recyclable. It is not recyclable, okay? It says that this one will never be recycled. There is one more item goes to OCI which will not be recycled. Can you tell me what? Revaluation reserve. It never goes back to P&L. It goes to retained earnings, but never goes to P&L. Similarly, so whenever you transfer the gain or loss as or in equity shares at FBT OCI to OCI, that will never be transferred to P&L. That will never be transferred to P&L. Okay, that's not recyclable. That's not recyclable, and this option is available only at the time of initial recognition. Okay, now understand a crux, a simple crux. Whenever you have an investment in equity shares, ideally it has to be classified at FBT P&L, but it can be classified at FBT OCI if it is held for long term and strategic reasons, but this option is only at the time of initial recognition and it is irrevocable. Further, it can be classified at cost if it is for investment in subsidiary, associate or joint venture, but that is an option as per Ind AS 27. Clear everyone? That's the whole story of investment in equity shares. Clear? So now this is this one, or you can write or. Okay, but yes, if you are measuring the investment in equity shares at cost, it goes out of scope of financial instruments, right? And that's what we studied in last class also. I'll just show it to you guys. Just read the first point. Investment in subsidiaries, associates or joint ventures, Ind AS 27, not applicable, right? Clear everyone so far? Now comes the measurement principle. Now comes the measurement principle of financial assets. Understand, at the time of initial recognition, where irrespective whether the financial assets are measured at amortized cost or fair value through P&L or fair value through OCI, at the time of initial recognition, financial assets will always be measured at fair value. Always at fair value. Now, what is the meaning of fair value? Fair value. Okay, now tell me, as per Ind AS 113, you have read it, right? What is the meaning of Ind AS 113? What is the meaning of fair value? A price where two willing and knowledgeable parties are willing to transact. Now, if I have purchased any financial asset, the purchase price itself is the fair value, right? So what I'll do? So when I say financial asset account debit to bank, student asks me, sir, you have not recorded at fair value, you recorded its cost. Baba, understand, this cost is the fair value. Okay, clear everyone? This cost itself is the fair value. So amount paid or the purchase price plus the transaction cost is the fair value at which I'll record the financial asset. Is that clear everyone? Now, financial assets are at fair value through OCI, again the same. But financial assets which are recorded at FBT P&L, understand, when I measure any financial assets at FBT P&L, the transaction cost goes to P&L. Okay, it is not capitalized with the asset. It is not capitalized with the asset. Okay, now, but for financial asset at amortized cost method and FBT OCI, transaction cost is capitalized with the asset. Okay, now I'm writing this crux here. Okay, transaction costs for amortized cost method and FBT OCI and for FBT P&L gets capitalized with the asset. These are small points, but if you make mistakes in this one, marks gone. Clear everyone till this one? Now, subsequent treatment. For amortized cost method, what will we do? We'll charge finance income, we'll record finance income at effective interest rate method. See, this amortized cost is exactly similar to what we studied for financial liability. In place of finance cost, you record your finance income. Now, if there was a transaction cost, we used to take EIR. If there is a transaction cost, we'll take EIR. If there was no transaction cost, we used to record finance cost at coupon rate. If there is no transaction cost here, we'll record finance income also at coupon rate. So everything remains the same. It's just the term changes from finance cost to finance income, financial liability to financial assets. Everything else remains the same. Okay. Now, will we record fair value changes? Will we record fair value changes for amortized cost? Right. So see, this one is at amortized cost. Okay. First column is for amortized cost. Second one for OCI. Third one is for P&L. So now tell me, will we record fair value changes? No, we will not record that. We will not record that. Settlement date, what we do? The amount which we receive, de-recognize at its carrying amount, differential will be transferred to P&L. FBT OCI. Again, we will record here finance income. We will record at FBT OCI also. Whenever an instrument is at FBT OCI, in that case also we do record finance income at effective interest rate. Okay, so understand, whenever an instrument is at FBT OCI, in that also CCFT passes. right? BMT B passes, right? Means there will be principal interest on specified dates. So you will receive interest. So you have to record the contractual receipts. You have to record the finance income there as well. Okay, definitely I take up an example. Don't worry at all about it. Now, and on every reporting date, I will have to compare the carrying amount with the fair value, and whatever is the gain or loss, I will transfer to OCI. Very good. Now, on settlement date, whatever is the amount of OCI, I will recycle to P&L. But if it was an investment in equity shares, at FBT OCI, it will never be recycled to P&L, retained earnings, okay, or other components of equity. Now, FBT P&L is the easiest one. Okay, now transaction cost is transferred to P&L on initial recognition. Will we record finance income? No. Only the fair value changes will be transferred to P&L. Okay, now this entry will remain the same, but the gain or loss will be transferred to P&L. Clear, everyone? Okay, now let's take up an example. This example that I have taken is from your ACCA, not from your CS syllabus. A good example, please try to solve it. I'm giving you 5 minutes time. But yes, I will say this is a very good example, covers all the aspects of measurement of financial assets. Is the question clear, everyone? Do you want me to solve, or you are solving it? See, it has the component of transaction cost, effective interest rate is given, fair valuation is also there. Now, see, there are 3 business models which is given. So accordingly, the same instrument you will have to account for under amortized cost, FBT OCR, or FBT P&L. Okay, so it will give you a very good understanding about the measurement. So please try to solve it. This is the question. So it says on 1st January 2001, I have issued, I have purchased 100,000 bonds. Okay, $100,000 bonds. 5% is the interest rate. Purchase price is 95,000. So purchase price can be different from the face value. Now the transaction cost which I have incurred is 2,000. So I will initially record the financial asset at what value? 97,000 for amortized cost and FBT OCI, and 95,000 for P&L. Okay, now this is the fair value given on each reporting date, and I say that I will redeem the instrument at 105960. Now this 5960 is the premium on redemption. This is also transaction cost, right? This 2000 is also transaction cost, and this 5000 is also transaction cost. So there are 3 transaction costs involved in this question. Okay, now let's read the question. What does it say? First one, Tokyo's business model is to hold the instrument until redemption date. See, the question just gives you about what? The intention. But analyze the instrument. Does CCFT pass? Tell me. CCFT pass? P? Yes. I? Yes. Specified dates? Yes. So, no other rights? Yes. So, CCFT passes. CCFT passes. Now, come here. Point number A. Point number A. You have to, it says until redemption date, means hold till maturity. So I will classify it under, very good, amortized cost method. Now under amortized cost method, how shall I record this one? Tell me. Now let's pass the journal entries. Let's pass journal entries. I think that will give you a better understanding. On the date of issue, date of purchase of instrument, okay, you will record financial asset account debit to bank. How much? 97,000. Very good. Now during the 3-year term, you will record it at financial asset account debit to financial income. Agree? Now year 1, year 2 and year 3. Tell me the amounts for each year. 97,000 multiplied by, what is the discount rate? Effective interest rate? Effective interest rate is 8%. So multiplied by 0.08 is how much? 7760. Now also I will receive something. Am I receiving something also? Just see, 5%, right? I will receive 5% also. Bank account debit to financial assets. So I will receive 5,000 here. How come? 100,000 multiplied by 5%. So whenever I have to calculate contractual payments, I will calculate on the face value using the coupon rate. But whenever I have to calculate the finance income, I will multiply the coupon rate, effective interest rate on the carrying amount. Okay, now, so tell me what is the value of the financial asset here at the end of first year? 97,000 plus 7760 minus 5,000. That comes to 99,760. Now again second year, tell me what is the finance income? $7,981. Very good. And contractual payments will be 5,000 only. What is the value of financial asset? $1,02,741. Okay. Now again come here. Third year, what is the finance income? Tell me. 8219. Amount will be 100 and tell me how much. So amount will be 5,000 with the payment plus 105960 is the principal plus premium. Right, now tell me what is the closing balance? Clear this one? Now this finance income will be transferred where? P&L. This payments will be transferred where? Cash flow. This balance will be transferred where? Balance sheet. Clear? Now, so first question is clear to everyone? Coming to second question. The business model is to hold the bonds till redemption, but also sell them if the investments with higher returns becomes available. Okay, so it becomes what? FVTOCI. Now, what will I do in FVTOCI? Listen to me very carefully here. FVTOCI is a replica of amortized cost. Plus, you have to do only one additional thing, is transfer the gain or loss on the fair valuation to OCI. What is the value here? 99760. What is the fair value? Tell me. At the end of first year, 1,10,000. What is the fair value at the end of second year? 1,04,000. You don't need to do anything. Transfer to OCI the differential. 10,240. $1,259. That's the only thing additional that you have to do. Is that clear, everyone? FVTOCI. Now FVT P&L is again very simple. 95,000. 2,000 transferred to P&L. Now 95,000 to 110,000. How much? 15,000 transferred to P&L. 110,000 to 104,000. 6,000 transferred to P&L. Right? So that's how I will record this entries. Clear, everyone? All the entries. So the third one should be P&L, I believe. The Tokyo's business model is to trade in short term. Tokyo sold this bond on 1st January 20x2 for 1,04,000. Clear, everyone? I think it's not a challenge. Yes, please.
So we have to change the OCA. You said 1,259.
Yes.
Actually reduce the OCA.
Yes, that's what we are reducing it, right? But we have to do it separately every year. And at the end of third year, we do everything, the carrying amount, the total accumulated OCI will be recycled to P&L. Okay. Now, so that's about FA measurement. Is that clear, everyone? Okay. Now comes the most important topic, is financial asset issued at off market terms. So before studying this topic, let me show you the relevance of this topic. Let's count. Okay, again, 1, 2, 3, 4, 5, 6, 7. Now 8 can be, I don't know when. Okay, so already 7 times it has come in the exam. Okay, and if you see, in all the attempts they have asked, almost all the attempts they have asked, right? They didn't ask in May 19. Again, they have not asked in last 2 attempts also. So you can very well understand that everything cannot be said now. Okay. Now otherwise we will say that, sir, you told that this will come in the exam, but it has not come. Okay. Now financial asset issued at off market terms. Now what is the meaning of financial asset issued at off market terms? Understand, generally, let's suppose if I am giving a loan to you, the market rate is 10%. I will give you a loan at 10%. This is normal market terms which we studied so far. Okay. Definitely there might be a component of transaction cost or processing fees due to which we will calculate the effective interest rate. But if I give a loan to you at a discounted rate itself, okay, at a discounted rate, I'm not talking about transaction cost, I'm talking about a discounted rate. Let's suppose you are my employee. Okay, generally the market rate of interest is 10%. I give you it for free. Okay, or parent company gives a loan to the subsidiary company for free, right? Again, that's a off market term. Right. So the question is, how will these be accounted for? How will these be accounted for? Whenever a subsidized loan is given by the employer to its employee, or interest-free security deposits. Understand? Whenever you take any property on rental, you have to give security deposit, right? On which you will not get any interest. But if you would have given that money or invested that money in a bank or fixed deposits or a term deposits, you would have got interest on that. So that's a loss of interest. That's the interest-free security deposit for you. So again, that's an off-market term, or a subsidized loan given by the parent company to its subsidiary. So all these things comes under FA issued at off market terms, in which the favorite topic is remains this one, employer-employee. Okay. Now, on the date of issue of such instrument, see, understand, accounting is governed by the transaction. The transaction is not governed by the accounting. Okay. So whatever transaction has happened, okay, now we have to do the accounting for that. So when they are doing the transaction, they will not see what is the accounting consequences for that, right? Now, if me as an employer have given loan to my employee at a fixed interest free rate, that's the contract is like that. Okay. So I cannot say if it's interest free, I will not charge interest in my books also. Okay. Though it was happening like this in ES regime, but it cannot be done here. Everything has to be accounted for at its fair value. Now tell me, if I have given a loan for no interest to you guys or to my employee, why? I will definitely not give any interest free loan to any party, right? Which I don't know, to any independent party. But why I have given to you? Right, basically I want to support my employee, right? Because I know if I support my employee by way of interest free loan, he will serve me better, right? So there is a benefit involved. There is a benefit involved for mine also, right? So what happens? This benefit that I'm passing on to you, for which I'm receiving what? Services from you, right? So this becomes an employee benefit cost for me. Now, let's suppose I'm giving you a security deposit, right? I'm losing my interest. Why? Because that's a sort of a form of rent that I'm paying to you. Okay. So that all those things are there. Now, if a parent company is giving interest free loans to its subsidiary, why? That's an investment in subsidiary. Okay. So all these things are there. Now, so it says on the date when the instruments are issued, on the date when such instruments are issued, see what are the contractual cash flows as per the contract. See, contractual cash flow, when I say what is given in the contract. Now calculate the present value of it as per the market rate. Meaning thereby, if I would have given a loan at a market rate, what should have been the fair value of it today? Okay. Now, so now whatever is the difference between the amount that you have paid and the fair value of the loan that you have given has to be recognized as, if it is a staff loan, you have to recognize it as employee benefit costs. But it's not that simple. What you have to see is there a service condition involved? Meaning thereby, let's suppose I have given a loan to my employee for 3 years and I told that you have to remain in service for 3 years. Means this difference I have to allocate over 3 years, like ESOPs, right? If there is no service condition, then I will transfer the whole amount to P&L today itself as employee benefit costs. Okay. Security deposit, whatever is the difference, I will transfer to ROU asset and depreciate over the lease term. Okay. If that is a loan from parent to subsidiary, I will record it as an investment in subsidiary. Clear, everyone? Now, subsequently, I have to recognize finance income at the fair value on discounting rate used and record contractual cash flow receipts. Clear, everyone? Now, a simple question on security deposits. Please solve this one. After this, I'll take up a question on employee as well. Is the question visible to all of you? Tell me what should be the journal entry on the date when the security deposit was given. Security deposit account debit. Then ROU asset account debit to bank. What is the amount that I have paid today? 20 lakhs. What is the amount of security deposit? 12 lakh. What is the amount of ROU asset? 7 lakh. Okay. Is it clear, everyone, till here? Now, this ROU asset I will or rather than amortize, I write depreciate. Now, this 12,99,800, how will this be accounted for? Let me discuss that part. Here I have recorded security deposit of 12,99,800. What I'll do, I will record a finance income of how much? Tell me, at the rate of 9%. Tell me what is the amount? 1,41,678. So what is the value of security deposit now here at the end of first year? $14, $16, 782, right? So accordingly, you will recognize finance income every year. 1, 2, 3, 4, 5. Okay. Now here it will become financial asset will become how much? 20 lakhs, right? And what will do? Bank account debit to security deposit 20 lakhs. 20 lakhs. Is it clear, everyone? So every year you have to record a finance income, and every year you have to record the depreciation cost for depreciation of ROU. Okay. So what will happen with this security deposit? Just understand this part. Unwind security deposit and record finance income and depreciate ROU asset. Okay, so two things will come in the P&L, which is finance income and depreciation costs. Is that clear, everyone? Any queries? This question, same question has been asked in the exam twice. A very easy question, just a little bit lengthy, but yes, the same question has been asked in the exam twice, just they have changed the name, that's all. Please solve this one. If it's not, you are not able to read it, then I'll do this way. First read this part, then I'll show the further parts. I'll explain the question, okay? Don't worry. Now it says that Lovely Limited has a policy of giving subsidized loans to its employees, okay, fine, for buying two-wheelers or four-wheelers vehicle. Now Simran, who is a sales executive, okay, wants to take a loan for four-wheeler vehicle from the company. The loan amount is 9 lakhs. The loan amount is 9 lakhs. You can see here. Please try to link also here so that I'll not have to see it time and again. It says the interest rate is 5% for the first 3 lakh and 8% for the remaining amount. Okay. So now I'm writing it here again. See here. 9 lakh is the amount of loan for the first 3 lakh and the remaining is 6 lakh. The interest to be charged is 5% and 8%, right? The interest rate is 5% and the interest rate is 8%. Now, The loan disbursed date is 1 April 17, which you can see from here. The loan tenure is 3 years. The loan tenure is 3 years. Prepayment. The loan can be prepaid fully or partially at the option of the employee, but the company doesn't ask for it. The employee can repay it off. Okay. The Simran shall remain in service means service condition is there. 3 years service condition is there. Okay. Now, the principal amount shall be recovered in 3 equal installments. See here, 9 lakh, 3 lakh, 3 lakh, 3 lakh, right? Now, at the end of each year and will be first applied to 8% interest bearing principal. So it says first you have to repay this, then you have to repay this, and which makes sense also. First repay the higher interest bearing principal. Accrued interest shall be paid on an annual basis. The market rate of comparable loan is 12% per annum. It says the market rate is 12%. Okay. Now, though we have given a discounted rate, but the market rate is 12%. Now, see, even though the question gives you a tabular format of calculating the what is the repayment of the principal, what is the payment of the interest, but just for understanding, let's calculate the payment of the interest. Okay. See, principal is very much sorted. Now tell me, how will I calculate the interest for these 3 years? First year, 9 lakh is the principal amount. 6 out of 9 lakhs, see, I'll show it here. First year, I do have 9 lakh as the loan. Out of which 3 lakh and 6 lakh. 6 lakh is at the rate of 8% and 3 lakh is out of 5%. So what is the interest? 15,000 and 48,000. Total 63,000. Just see, is it written same? 48 and 15 clear? Second year. Again, the loan becomes how much now? 6 lakh. Now, 3 lakh and 3 lakh at the rate of 5%, at the rate of 8%. Now, this will remain at 15,000. This will be 24,000. So, what is the amount? 39,000. Now, third year. Loan is 3 lakh only now. So, now this 3 lakh, this is also remain paid. So, it is at 5% only. So, it becomes 15,000 only. Just see, is it matching everything? Right? So, this table is clear to everyone, and this table has all the data now. So, I don't need to read any further data from top. So, now you can just see this one. This is a subsequent part which will do the accounting subsequently. But tell me, on the date when the loan was issued, tell me what should be the accounting treatment on the date of loan given. What should be the journal entry? Tell me. I will tell only one thing, to bank, 9 lakhs. You have to tell me what will I loan to, amount, so you know the contractual cash flows, 3 lakh 63 for the first year, 3 lakh 39 for the second year, 3 lakh 15 for the third year, right? Discount rate is 15%. 15 or 12? 12%. Okay, fine. Discount rate is 12%. So tell me what is the present value? 7,20,549. The difference will be transferred to? No. Service condition exists. Service condition exists. I cannot transfer the whole amount to P&L as of now. I will treat it as a prepaid expense. Prepaid employee benefit expense account debit. How much? 1,79,451. Okay, now is it clear everyone so far? Now every year end, what will you do? You will unwind this loan and record finance income and record contractual cash flows. Prepaid cash flows, you will record employee benefit expense. Clear? Now, on the date, on what date? On 1st April, 31st March 19. On 31st March 19. Please tell me what is the carrying amount of loan? 19 or 17? How come 0? 1 year still remains, no? On 31st March 19, what is the carrying amount of loan? Calculate. What happened? Come on guys, tell me on 31st March 19, what is the carrying amount of loan? This we have calculated on 1st April 17. Madam, you are understanding? What happened? On 1st April 17, the loan is measured at 720,549. You will unwind every year. 3 years was the term of the loan, right? 17 to 18, 18 to 19. But 19 to 20, I'm not asking. 17 to 18, 18 to 19. What is the carrying amount on 19, 31st March 19? 720,549 multiplied by 1.12 minus 3,63,000 multiplied by 1.12 minus 3,39,000. 158,296. Please confirm, is it clear or not? 720,549. I believe this amount is correct. Though I am little bit dicey about this amount being correct. Just let me check, Baba. 49 into 1.12 minus 363,000 into 1.12. This amount is wrong. This amount is wrong. Let's calculate it. Year 1, 2, 3. Contractual cash flows is how much? 3,63,000. 3,39,000 and 3,15,000. Right? Present value at the rate of 12%. Can you please tell me what is the amount? Is the discount factor given in the question? No. 0.89329, 0.7972, 0.7118. Okay, now 363,000 into 0.8929, 324,23. Who sent me the answer earlier? Now, why are you changing your answer? But what if it's silly mistake is done in the exam? And then you will say, sir, I solved it correctly only. Eight one? Yes, that's what I'm getting. 818,591. Exactly is what I'm getting. $818,591. What is this amount? $81409. Clear till here? Now, please tell me the carrying amount of loan on 31st March 19. This also I will find. I have calculated, but I needed the answer from you guys now. Simple, no? 818,591 multiplied by 1.12 minus 363 multiplied by 1.12 minus 339. Tell me the amount. After so long and after so wait, the answer is here. 281, 280. Okay, fine. Now read the question. Simran got lots of money now. Simran prepays 1 lakh. Okay. On 31st March 19. Now if the Simran prepays a loan, that is from here Simran prepays 1 lakh. Okay, let's adjust it off. Prepay. Prepay how much? 1 lakh. So what is the carrying amount now? 181 280. Correct? Now, but understand, when Simran prepays the loan, the remaining schedule will also get disturbed, right? Now what I have to do? I will again have to remeasure the loan again, right? So what it says? It says that the remaining cash flows is this much, 2,10,000, right? So let's calculate what is the fair value of loan now. On this date, what is the fair value of loan? Is present value of 210,000. At what rate? At 12%. Tell me what is the amount? 210 divided by 1.12 is how much? 187,500. Now understand. This is the benefit to the employer. Okay, this is the carrying amount of my asset. This is the fair value of the asset. The difference will be transferred to P&L. What is the amount? 187,500 minus 181,280 is 6,220 is the P&L gain, and this gain will be adjusted where? Adjusted with the employee benefit expense. Is it clear? This is what is required in the answer. See the question, read the question now. You are required to pass journal entries in the books of Lovely Limited considering the requirements of Ind AS. Okay, now they are asking something different. They are asking, please pass the journal entry for the overall 3 years. So see, on the date of issue, we have already given pass the journal entry. For the first year, second year, you will have to unwind this loan. You have to record the employee benefit cost for this one. You will come here and what you will do, you will say this is the carrying amount, this is the fair value, this is the amount to be adjusted again, right? Now again, the next year you will unwind the loan and pay the amount, right? Receive the amount, sorry, and then you will record the employee benefit expense for the remaining amount. Clear everyone? Though this question seemed very lengthy, but the answer is very small. And how many marks? See, so easy question paper comes for FR. Huh? Is it clear everyone so far? Clear? Anyone having any queries? We can continue or you want break? 10 minutes? Okay. Because the today's class will be not much longer. I will complete the financial instruments and then we'll wrap up. Okay. Let's break for 10 minutes. Let's assume. Now, so before break, we were studying about the financial assets majorly. And in financial assets, we discussed the classification, the measurement, and the financial asset of market terms. Right now, we have to understand. See, initially we have to classify the financial asset at amortized cost or at financial assets at fair value through OCI or fair value through P&L, based on the intent and based on the nature of the instrument. Definitely, the nature of the instrument will not change in going forward, but the intent might change. Right, the intent might change. And due to change of the intent, the classification has to be changed subsequently. Okay. Now, so basically understand, first and foremost point, reclassification is not allowed for investment in equity instruments, right? That is at FBT OCI, it's not allowed. That is irrevocable option. Okay. Now, but for others, for all other financial assets, we can do change the classification of the assets. Understand. In our childhood we used to play cricket, right? Whenever we used to play, what happens, we used to always take this one, that if we have to change the rule, after this game we'll change the rule, right? Same thing happens here. Whenever we have to change the classification, till the date of classification we have to apply the old rule. From the date of classification subsequently we'll apply the new rule. Is that clear point? That's what applies here. Now step 1, apply existing classification till the date of reclassification. Okay, now transfer the existing classification to new classification, okay, on from the date of reclassification. Now I'm not taking this one, the theory of India's, but rather I'm taking an example and explaining everything. Okay, now just remember only one thing, subsequently we'll apply the new rule. Okay, this is the question. Same question we'll discuss for all the classifications. See, amortized cost to FBT P&L, amortized cost to FBT OCI, FBT P&L to ACM to OCI, OCI to ACM, OCI to P&L. All the possible cases I have taken using the same example. Now, amortized cost. It says the question is the carrying amount on the date of reclassification is 100,000 and its fair value on the same date is 90,000. Okay, so first what I'll do, the fair valuation through P&L I will apply subsequently, not now. So first I will write here fair financial assets at FBT P&L I will recognize at 100,000 and I will de-recognize what financial assets at amortized cost method at 100,000. Clear? But now understand, subsequently it says the fair value on the same date is 90,000. So now, though this is at 100,000, but I have to bring it to 90,000 also. So what I'll do, I will record the gain or loss in the P&L. So P&L account debit to financial asset at FVTPL 10,000. Now, when you will see the journal entry in the book, you will find it written as FA FBT P&L 90,000, P&L 10,000, FA amortized cost method 100,000. So you will say that okay, it's transferred to P&L and then transferred to OCI, then transferred to FBT P&L. No, first transferred to FBT P&L, then transferred the gain or loss to this one. Now, again, in this one, the same entry will be passed first. Right? First, I will transfer the whole of the assets to FBT OCI. Let me write it. Financial assets at FBT OCI debit to financial assets at amortized cost method 100,000. Then I will write here OCI account debit to FA at FBT OCI 10,000. Clear? Now coming to FBT P&L to OCM. Now what happens? See, it says the carrying amount is 100,000 but the fair value is 90,000, right? And my earlier classification is FBT P&L. So first I will bring it at fair value. So first what I'll do, P&L to FA at FBT P&L, right? 10,000. I'll say, see, everyone says that reclassification I get confused, and I'll explain why you get confused and why you should not get confused. I'll explain that as well also. Don't worry. Now, your carrying amount was 100,000. You brought it to fair value first, that is existing classification. Now you will transfer it to amortized cost method. So you will write journal entry as financial asset at amortized cost method 90,000 to financial asset at FBT P&L at 90,000. Now do one thing. For this one, please pass a compound entry. Entry will be FA at FBT P&L 90,000, FA P&L 10,000 and FA at amortized cost method 100,000, right? For this one, FA at, I'll write the journal entry, don't worry, FBT P&L 90,000, P&L 10,000, then to FA at amortized cost method at 100,000. Now please pass a compound entry for this one also. So it is FA at amortized cost method, P&L account debit 90,000, 10,000 to FA at FVTPL is 100,000. Generally, a student gets confused, sir, if I am transferring amortized cost to FBT or FBT to amortized cost, the impact in both the cases gets transferred to P&L, right? So, and don't understand it this way. If you pass a compound entry, you will get confused. Okay, don't pass it this way. Always break the entry into two parts. One is for the transfer, one is for the recording the gain or loss. Clear? So break the entries. See, always, definitely I understand that passing a compound entry saves your time in the exam. Okay, but how many? Right? Might be for per entry 5 seconds, 10 seconds, right? But I think spending 5-10 seconds more is worth it when you are scoring more marks for that. Okay. So what happens is when you break the entries, the chances of making mistake reduces. Now again, FBT P&L to FBT OCI. Now tell me, first what will I do? I will record the gain or loss because it should be at a fair value. So I will write the same entry first. I will write the exactly same entry first. Then what I will do is I will record the asset at FA at FVT OCI to FA at FVT P&L. 90,000. Right? Now, if you are transferring from P&L to OCI, you will record the gain or loss in OCI or P&L. Transferring the asset from FBT P&L to FBT OCI, you will record the gain or loss in P&L or OCI? P&L, right? Why? Because first you will record the gain or loss, then transfer the asset to, very good, very good. Now coming to this case, when you are transferring the asset from FBT OCI to amortized cost method, tell me, logically tell me what will happen. First, what will you do? You will record the gain or loss for OCI and then transfer the asset to amortized cost, right? But now tell me, whatever is the balance in OCI, what will I do for that? No, I will transfer that to as financial assets at amortized cost method. Are you understanding this? See, this is an exception. So you can say sort of an exception. So basically what you have to do is, I'll tell you. First, what will you do? You will record OCI account debit to financial asset at FBT OCI at 10,000. Clear? Now, just a minute. I'll have to transfer that entry there. Then further, you will write the second entry as, in this case only, financial asset at amortized cost method to financial asset at FVTOCI, right? Now, this one, what happens? This one is at 90,000, right? So, this is very much clear. The question comes up, how will you treat OCI? So standard says that you have to transfer this to the asset. That's what is written here. See, if the new classification is fair value, then consider the fair value on the date of classification. Fine. If the classification is changed from FBT OCI to any other, then OCI reserve already created will be transferred to the book value of the financial asset if the new classification is amortized cost method, or transferred to P&L if the new classification is FBT P&L. Now see here, in this case what I will do? In this case I will transfer this OCI to P&L. Is that clear now? So what you have to do whenever a question on reclassification comes in the exam, break the journal entries. Don't memorize anything. Okay, what again a student does a mistake is, they think that, sir, I will memorize all the journal entries. If you do, guaranteed you are doing a mistake in the exam. Okay, because journal entry is this much, how can you remember everything in the exam? Okay, but yes, if you have a very good memory power, then it's a different story. Okay, now, is reclassification clear to everyone? Anyone having any queries? Remember, I can ask questions in between also to anyone. I can pick and ask. Now, impairment of financial assets. What is meant by impairment of financial assets, and why don't we check impairment of financial liability? Why only impairment of financial assets? That I have to pay, right? So I definitely don't have any obligation on the like any question on the payment that I'll pay or not. I definitely don't. I'll pay. If I don't know that, if I think that I'll not pay, I will write it off. That's not a challenge. But when it's a financial asset, it's my right to receive, but it's an obligation for someone else. That someone else will pay me or not is a question, right? So whether I will be able to recover this financial asset or not is a question, right? Now think about the investors who had Adani shares, right? They definitely had a question on like whether I'll be able to recover the money or not. But yes, understanding, considering the fundamentals of the company, definitely they would have thought that yes, they will recover the money. But yes, it raises the question on the impairment, right? So because impairment means testing whether I will be able to recover this money or not. Impairment doesn't mean anything extra, okay? Whenever I take the name impairment, you shouldn't think, oh, this is something very extra. No. Impairment, generally, impairment means whether I will be able to recover this money or not. That's all. Now, whenever a question comes on amortized cost method, basically financial asset at amortized cost, is the asset at you can say fair value? No. This I purchased, okay? This I purchased at 300 and this fell down. The value decreased, it broken down, the value decreased. Definitely I have to impair this, I have to decrease the value. It is recorded at 300, but I will not be able to realize even a single penny from the sale of this calculator now. So is it worth to record this at 300? No, I have to impair it now. But this is not covered in financial instruments, right? So it says whenever you record any financial assets at cost, right, you have to test it for impairment. Whenever you record any assets at fair value through OCI, see, whenever any asset is at fair value, means what? The amount which I can realize from this one. So it's already at fair value. Will I test the asset for impairment? No. But tell me, is the impact going to P&L? No. So what I have to do? Whenever we have to test an asset of at FBT OCI for impairment, I will definitely test it. But if there is any impairment, I will not impair the asset, but I will just transfer the OCI to P&L. Clear? I will just transfer the OCI to P&L. Now, just explain, tell me one question. I am asking you one question. If the investment in equity shares is at FBT OCI, can I impair that? Cost. No, is that FBT OCI? Can I impair that? Exactly. First, I don't need to impair the asset because it is already at fair value. But question comes up, for FBT OCI, I have to transfer OCI to P&L. Now, for investment in equity shares, can I transfer the gain or loss to P&L, the OCI? No, I cannot transfer that, right? So see here, investment in equity shares of another entity at FBT OCI, no, I cannot impair it. I cannot impair it as OCI cannot be recycled to P&L. So I will not be able to impair the investment in equity shares at FBT OCI. The one which is at FBT P&L, is it already at FBT P&L fair value with the impact going to P&L? So no impairment loss recognized anyways. Okay. Now see here, the assets at FBT P&L, no, will not test the asset for impairment. Why? Because they are already at fair value with the corresponding impact going to P&L. So no point again impairing the asset. Clear, everyone? So what is the crux? We will test only these two assets for impairment. We'll test only these two assets for impairment is the crux. Only these two. Clear, everyone? Now accounting treatment, the journal entry. Whenever we recognize impairment loss, okay, this is exactly similar to Ind AS 36. What do we do whenever we record an impairment loss on the non-current assets? Do we decrease the value of the assets? No. We record a provision which we net off in the balance sheet, right? Exactly what we will do here. So we will record a provision for loss allowance. We will record a provision for loss allowance. Loss allowance is just a term for impairment. Okay, you can say provision for loss allowance, you can say provision for impairment of financial assets, you can say provision for ECL. Okay, anything you can say. ECL means expected credit loss. Okay, it's just a name. It's just a name. Now, loss allowance account debit to provision for loss allowance. Now, and if it is a FBT OCI, then loss allowance account debit which will be transferred to P&L to OCI reserve. Now, whenever the asset is at FBT OCI, will I record any provision? No. Why? Because this doesn't require any adjustment to the financial assets, because asset is already at fair value. It's just that I have to transfer the impact from OCI to P&L. But whenever the asset is at amortized cost, we have to take the impact in the asset also. So that's the reason I recognize a provision which will be net off in the balance sheet, and I recognize this loss allowance in the P&L. Clear, everyone? So that's the journal entry. Now, measurement. Understand the ECL or the loss allowance or the impairment of financial assets can be of two types. One is 12-month ECL and one is lifetime ECL. Basically, 12-month ECL is like provision for bad debts, meaning thereby there is no challenge in recoverability, okay, but it's an estimate that it's a company policy that I'll record a 5% provision on bad debts, okay, because see, however certain a receivable might be, but there is still a little bit probability that amount might not be received, right? But there is no challenge the recoverability. Now coming to second situation, the asset is becoming credit impaired, meaning thereby you have a doubt that this amount will not be received, okay, and that has happened in the past also, and in the past I have not received certain amounts, okay, or the credit rating has reduced significantly. So whenever the asset becomes credit impaired, you have to create lifetime ECL. Whenever the asset is not credit impaired, you have to create 12-month ECL. It's like a provision for bad and doubtful debts. Now understand. So first identify whether you have to record a 12-month ECL or you have to record a lifetime ECL. Okay, when we create lifetime ECL in the case whenever the significant credit risk is there or the FA becomes credit impaired, okay, or it's a short-term receivables. Now understand, short-term receivable, don't you think if we say 12-month receivable, that's the lifetime of that, okay. Let's suppose if I say trade receivable, which will be recovered within 3 months, okay, I have to create 12-month ECL on that. So don't you think it's the whole life of the ECL, right, asset? So for those also we'll record lifetime ECL, right? All other cases I will record 12-month ECL. Is it clear, everyone? The case where we have to record lifetime ECL and the case where we have to record 12-month ECL. Is that clear? So always remember, whenever a question comes in the exam, they will write a term significant credit risk or they will write a term credit impaired, which will help you in identifying whether you have to create lifetime ECL or not, okay. If the question is not giving any identification, 12-month ECL. If the question is giving such indications, lifetime ECL. Then second step is you have to calculate the expected credit loss, means expected losses. What is the loss in the future, okay, which will be calculated using present value, which will calculate using present value of the expected future cash flows that will not be realized, okay. Now if it is 12-month ECL or if it is lifetime ECL, if it is 12-month ECL, what you will do is whatever is the losses that you have identified, you will multiply it with the probability of default within the next 12 months. What is the probability of default within the next 12 months, okay. Now if it is lifetime ECL, you will not multiply with probability, rather you will recognize the whole amount as the ECL multiplied by 100%. So only difference between 12-month and lifetime ECL is in 12 months we multiply with the probability of default within next 12 months, and in lifetime we multiply with the 100%. Clear, everyone? Good. Again an example which I have taken from a ACCA material, a very good example which will explain the movement also. Please try to read the example and try to solve it, all of you. Just listening to the class won't help. Please try to solve the questions on the examples you have taken in the class. So now tell me, we will create 12-month ECL or lifetime ECL here? Why lifetime ECL? I am talking about 1420x1. See what does it say on first on this date any credit risk is there? See, the portfolio was initially recognized at this value. Entity estimates the present value of the future default is this much with the probability of default within as 5%. As on 31st March 2002, the credit risk increased significantly. So on this date, the credit risk increases, but not on this date. So here I will create 12-month ECL, which is equals to 5,000. Right? Now, how will I show in the balance sheet? In the balance sheet, I will show 840,000 minus 5,000 as 835,000. Now, how will I show in the P&L? In the P&L, I will show loss allowance of 5,000. Very good. Now come to year end. It says that as on 31st March 20x2, the credit risk increased significantly. The expectation of the default remains the same. Analyze. Now, please tell me what should be the finance income that I'll charge here. 7.5% of what is my question? 1 lakh. Why 1 lakh? Finance income is on the assets. Is that an asset? Is the probability of the present value of the default? I'm talking about what is the finance income on the asset. 840 or 835? 840. Okay. Why 840? Why not 835? Because the carrying amount is 835. Okay. I'll come to that point now. Just this 840 is correct so far, but I'll explain the logic. Don't worry. Into 0.075 is 63,000. Right? So your asset becomes how much? 983,000. Right? Now, what is the lifetime ECL now? Calculate lifetime ECL. No 1 lakh. How did we arrive at 1 lakh? Tell me. See, read this line again. This is where we make mistake by not reading the question properly. Entity estimates the present value of the default as 1 lakh. Now, don't you think it was 1 lakh here? If you come here, you will unwind that present value. So what is the present value of defaults? $107500, right? And will we multiply with the probability or 100%? Now, what should be the reported in the balance sheet now? 9,03,000 minus 107500 is 795500, right? Now, though the question doesn't ask, but I am asking you, if I have to prepare the finance statement for this year also, I will charge finance income what? What will be the finance income? 7.5% of what? 903 or 7955? Why now 7? Here you told 840, now you're telling 7955. Why? Pardon? It's not about permanently. See, again, we will recognize a provision and in the balance sheet we will then do net off. Okay. Now, so why 795500? Understand here, first and foremost point. Just a minute. Okay, I'll write it here. Don't worry. Finance income. Whenever you charge a 12-month ECL, okay, no impact on finance income. No impact on finance income. That is, we have to calculate finance income on gross financial assets, because that's just a provision. There is no challenge in the recoverability. Okay. Now, whenever we create lifetime ECL, you have to create finance income on net assets, but that has to be done prospectively. Meaning thereby, if you have created a lifetime ECL here, if you have created lifetime ECL here, doesn't mean that the finance income for this year will get impacted. The finance income for the future years will get impacted. Clear? The reason is, see, 12-month ECL is just a provision, okay, no challenge the recoverability. But here what happens, there is a challenge the recoverability of the principal amount. Then how can you create an interest on the principal which you are not expecting to recover, right? So if you are not recovering the principal, definitely you will not recover the interest on that principal. Okay, so that's the reason we take on net assets. Clear, everyone? That's all about your impairment of financial assets. Is it clear, everyone? Now, coming to derecognition of financial assets. Now, derecognition. What is the meaning of recognition? When do you recognize a financial asset? You recognize the financial asset when there is a contractual right to receive cash, right? But when this right itself expires, you have to derecognize. Now, this right can expire in multiple forms. I have realized the cash, the right expires. Okay, if there is a derivative asset, it becomes a potentially unfavorable condition for me, right? Then that right again expires. Or might be I have realized the derivative asset, so then again the right expires. So this is about the right expiry of the right, and I believe it is clear, everyone. Coming to the rights to cash flow are transferred. Link it with the factoring. Now what happens in factoring? Let's suppose I had a receivable, that is a contractual right to receive, but I sold that receivable to a bank and realized the money. But now this sales can happen in multiple forms, recourse or non-recourse, meaning thereby if the other party from whom I had a right to receive defaults on the payment, bank can come to me. If the bank can come to me, means I am still interested in the asset, right? Still I do have the risk and rewards attached to the asset. In that case, you cannot derecognize the asset. Even though you are saying that you have sold the asset to the bank, you cannot derecognize the asset. Then how will I treat that? Listen to me carefully here. So basically what is happening here is, I had a trade receivable which I sold to the bank on a recourse arrangement, means bank can come to me in the case of any default. So the trade receivable will continue to be recognized in my books of account. But you are saying that I have sold this to the bank. So definitely when I sell, I will get the money from the bank. That money which I have got from the bank will be recognized as a separate financial liability. Clear, everyone? Now, if this trade receivable has been sold to the bank on a non-recourse arrangement, means in the case of default, bank cannot come to me. Now it means I have transferred this receivables along with the risk and rewards, or along with the control. In that case, I will have to derecognize the financial assets, recognize the sale proceeds, recognize the gain or loss on the sale. Is that clear, everyone? That's what it says. If transferred along with the control or substantial risk and rewards, then derecognize FA. Transfer is with recourse, do not derecognize FA. Transfer at non-recourse arrangement, derecognize FA. Clear, everyone? Pass-through arrangements. Now what is the meaning of pass-through arrangements? What happens? I had a receivable from another party, okay? I'll prepare a diagram and explain, okay? This is me, VJ, okay? These are my students, okay? Now this is bank, okay? There are, let's suppose, 50 students, okay? I had to receive the fees from them, okay? Which the students told that, sir, I'll pay you after 1 month, okay? Now I am in need of money, so I go to the bank and I tell that give me money on the basis of this receivable. So, but students are telling me, sir, I will pay only to you, not to the bank. Okay. Now what will happen? Can the bank recover from the students? No. I will have to recover from the students and give to the bank. So then in that case, how will I factor it off? How will I sell this receivable to the bank? This arrangement is called as pass-through arrangements, wherein what will happen? I will say to the bank, I am selling this receivable to the bank. I will collect the money from the bank, but there are certain conditions to be followed. First condition, whatever amount will be received from the students will be received by me. Whatever amount will be received from the students, whatever amount, okay, I will transfer it to the bank. Whatever amount I will receive from the students, I will transfer it immediately to the bank. Okay, there should not be any time gap. There should not be any time gap. Okay. So what is happening? These fees is going to the bank, passing through me. That's the reason it's called as pass-through arrangements. Pass-through arrangements. Now, what is the meaning about? See, right to receive cash flow is retained. Right to receive cash flow is retained. Okay, but entity assumes an obligation to transfer such cash flow at actuals without any delay. In that case, you can derecognize the FA. Okay, so understand, you can derecognize FA in 3 cases. When the right to receive cash flow expires, then what? Tell me. Transfer on a non-recourse arrangement. If it is on a recourse arrangement, you cannot derecognize. Whether if you have received any amount, recognize that as a financial liability. Third one is pass-through arrangements. Pass-through arrangements means I do have a right to receive cash flow, but I assume a liability as well, wherein I will transfer all the amount which I receive. If the right to receive was 100, okay. If I receive 1 rupee, I will transfer 1 rupee. If I receive 100 rupee, I will transfer 100 rupee. If I receive 1000 rupee, I will transfer 1000 rupee. Okay, whatever I receive, I will transfer. Doesn't matter less or more, doesn't matter. There is no risk. I am just a collecting agent. Okay, I will collect on the behalf of the bank and transfer it to the bank. Is it clear to everyone? Now, so that's all about derecognition of the financial assets. But now understand, the derecognition can happen either full or partial. Now, when you are doing, just a minute, where exactly I have written it? Okay. Whenever the derecognition happens partially, it's not that I can say that I will transfer this much or I will transfer this much. No, one time I'm transferring, one time not transferring. It's not happens. It should be systematic manner. 1. I will say I will transfer the whole amount of principal to you, or I will transfer the whole amount of interest to you. Second, I will transfer the 50% of principal and interest to you, or I will say I will transfer the 50% of principal or interest. See, here it was and 50% of principal and interest. Here I am saying 50% of principal or 50% of interest. Okay, so it can be, I can transfer full principal, full interest. I can transfer partial principal, partial interest. I can transfer partial payment of principal and interest. Okay, so this is the manner wherein I can transfer the financial assets. Now, how will I do that? How will I do that? That is called as, you can say, securitization also it is called. Okay. Now, in the securitization, what I do is, I have to first calculate the fair value of the securitized component. Okay. Basically, what is the component that I'm selling it off? Okay. Now, for that, I have to calculate what is the fair value of the total loan on the date when I'm selling it off, minus what is the fair value of the principal or interest component that I retained. Okay. Minus what is the fair value of the service component. Service component means, let's suppose contractual right is with me. Okay, so who will collect all the money? Me, right? So there will be a cost involved for me to collect the money, right? So definitely I will charge a service component. So what is the fair value of the service component? So I will reduce everything which I have retained with myself. Now the fair value which remains is called as the fair value of the securitized component, means fair value of the transferred component. Okay, now what I have to do is allocate the carrying amount of loan. See, this one we calculate fair value. Here in step 2 I am saying about carrying amount, right? What I have to do is, first I have to calculate the fair value of the total loan, fair value of the transferred component, fair value of the retained component, fair value of the service component. Okay, I will identify this one. Now I will identify what is the fair value of the loan, sorry, carrying amount of the loan. Then I will allocate the carrying amount to each of the components. I will allocate the carrying amount to each of the components in the ratio of this fair value. Understand now? When I am calculating this fair value, what is the purpose of calculating the fair value? Will I recognize the financial asset at its fair value? No. The only purpose to calculate the fair value of the retained component, transferred component, service component is to allocate the carrying amount in that ratio. Okay, so that I will know what is the carrying amount of the transferred component. I will know what is the sale proceeds that I have received. Sale proceeds I know, carrying amount I know, I can recognize the gain or loss on sale, right? That's what I'm saying. See, bank debit is the consideration received. Financial assets, the allocated carrying amount of the securitized component means the transferred component. P&L is the gain or loss on derecognition. Is it clear, everyone? Basically, what I'm doing is, understand it again. I have to calculate the fair value. I have to calculate the fair value of the retained component, transferred component, and service component. Then, definitely on the date when I'm selling, I will know what is the carrying amount. So, in the ratio of that fair value, I will allocate this carrying amount. Okay, understand it. See here. Let's suppose there are three components, right? Just trying to explain. Transferred component, retained component, service component. Okay, I will know the fair value is 5, 10 and 12 or 15, let's suppose. It's 15 and it's 5. Okay, this is the fair value, let's suppose. Okay, now the carrying amount of the financial asset overall is, let's suppose, 12. Okay, now how will I identify what is the carrying amount of the transferred component? I don't know, right? See, it's very difficult for me. As what I'm doing is I'm transferring 50% of the principal, or 50% of the interest, or 30% of the principal, or I might transfer the whole of the interest. So calculating the allocated carrying amount of that will be difficult. So what I'll do, I will definitely calculate the carrying amount of the full financial asset. I can calculate the fair value of the full all these components. Now for the transferred component, can I allocate the carrying amount, which will be 12 multiplied by 15 divided by 20, right? Which will be equals to how much? 8, right? Now I know the carrying amount of the transferred component is 8. I have sold it for 9. So 1 is my gain or loss on sale. Clear, everyone? Now, continued involvement asset. What happens is I have transferred the whole of the asset to you. I have transferred the whole of the asset to the third party. Okay, and I have transferred in a non-recourse arrangement. Basically, they can, if in the case of default, you cannot come to me. Okay. So, and a transfer basically substantial risk and rewards or along with the control. But for a portion, a minor portion of it, I'm still still you can say interested in that asset. Let's suppose if the loan which I was a receivable was there for 10 lakhs, okay, but I am still interested for 1 lakh, meaning thereby the party to whom I sell the financial asset says me that Vishal, if there is a default to the extent of 1 lakh, you will have to bear it. But 1 lakh is not the substantial portion, right? 1 lakh is not the substantial portion. So just because it is not substantial, I cannot say. Understand? Financial asset was 10 lakhs. I am still interested in the asset for 1 lakh. I am still interested. Okay, the defaults up to 1 lakh I will have to bear. But does that mean it is substantial? No, it is not substantial. If it is not substantial, can I stop the derecognition of this one? No, I will definitely derecognize this one. But what about this 1 lakh? Definitely I have to do something for this one, right? So I will record a continued involvement asset for this one. How exactly? See here. Financial asset is transferred, that is qualifies for derecognition, but entity has provided a guarantee on it. Okay, a guarantee on it that up to 1 lakh I will bear the loss. Then step 1, derecognize the financial asset at its carrying amount and record the gain or loss on sale, which is very much clear to all of you. Step 2, recognize a continued involvement asset at lower of. What is the amount of receivable? 10 lakhs. What is the amount of guarantee? 1 lakh, right? So what is the lower? 1 lakh. So I will have to recognize an asset for 1 lakh again. Now, recognize an associated liability. Why do you need to recognize a liability? Because if this guarantee materializes, I will have to pay the amount, right? Now for that I have to record a liability as well. So I have to record a liability at guarantee amount, that is 1 lakh plus fair value of that guarantee, okay? Now, any difference is recognized in P&L. How exactly? See, in the bank, I will record the sale proceeds, financial asset at its carrying amount, continued involvement asset at its lower of guarantee or carrying amount of the financial asset, associated liability at guarantee amount plus fair value of guarantee, The difference will be transferred to P&L. Clear everyone? Now, so there comes an end of financial assets. Any queries from a financial assets perspective? So we discussed measurement, classification of financial asset, we discussed the measurement of financial asset, we discussed the financial asset at off market terms, then we discussed the reclassification of financial asset, then we discussed the derecognition of financial asset, then we discussed the continued involvement or securitization of the financial asset. Tell me guys if you have any queries in these topics that we studied so far.
The one that the party pays the full amount to the bank. So our liability gets cancelled.
Okay.
So then how will we recognize? Like CA will be guaranteed or guarantee amount or
See, the guarantee amount is what I have given to the bank. Okay, is I don't have any relation with the the party from whom I have to receive the money, right? I don't have any relation with him because I have de-recognized the receivables. Now there is a relation between me and the bank, not me and the customer. Okay, so what I have to do is I have to record a guarantee because I have given a guarantee to the bank, right? I have given a guarantee to the bank, so I have to record the guarantee amount, whole amount of guarantee. So what you will find here is I am recording an asset, I am recording a liability of the similar amount, okay? At the date of settlement, when nothing is materialized, I will cancel each of them. Okay. Now, coming to treasury shares. If you purchase investment in the shares of Reliance, how will you record it as? Financial asset. But if you purchase the shares of your own company, will you record it as an investment? No, that's sort of a buyback, right? But let's suppose I have not cancelled the shares, then how will I record? So it is then we record it as a treasury shares. Okay. So entity reacquires its own shares and the amount paid is directly to be adjusted from equity. That is, do not recognize any gain or loss on the cancellation of such equity capital. Basically, you have reacquired your own shares. Okay. So whatever is the gain or loss, if you have any, will be adjusted with the equity, no other gain or loss. Is it clear, everyone? Now, offsetting FA and FL. Offsetting FA and FL. Tell me, when can we offset any FA or FL? Tell me. Logic based. Logic. I have an FA from receivable from you, but payable to her. Can I offset? No. I have a receivable from you, but payable to you. Can I offset? Yes. So if there is a legally enforceable right to set off. Okay, I do have a legally enforceable right to set off. But now you say that, sir, even though it's a receivable and payable for the same party, let's not settle on a net. We'll settle it separately. So intent to settle on a net basis should also be there. Okay, see, there is an and, there is an and. Okay, I do have a right to settle it net. I do have an intention to settle it net. Okay, meaning thereby I do have an ability. I do have a willingness. If both is there, then yes, I can offset, otherwise no. Okay, clear everyone so far? Now we are moving on to basically some special cases. Foreign currency convertible bonds. Think from the point of the company who has issued this instrument. Okay, so basically, see, I have taken it from both the points. Foreign currency convertible bonds from the point of view of issuer, from the point of view of investor. I have taken from both the points, so don't worry at all. Investor. Now, understand. The question is, whenever a company issues foreign currency convertible bonds, okay, this is, let's suppose, Infosys. This is, we know that the Infosys has a major operations in US, right? Now, Infosys wants to issue a foreign currency convertible bonds in US. Okay. Now, understand. Convertible bonds into fixed number. Okay. And it's compulsory convertible. Compulsory convertible into fixed number. But now, see, though the number of share is fixed, it is compulsorily convertible. But the loan amount, tell me, the loan amount, is it fixed? The loan amount will keep on changing. So what will it become? Sort of a derivative? The loan amount will keep on changing. Now, for any instrument to be classified as equity, it should pass what? Fixed to fixed test means the amount of loan is also fixed, number is also fixed. Here the number is fixed, but the loan amount is not fixed. So ideally it should be a financial liability. But Indian scenario, India 32 says it's an equity instrument. Okay, that's an exception. But if you go as per IS 32, that is in the foreign countries, it will be a financial liability only. Okay, so that's, you can say, a difference. That's a difference. Okay, a theory question can come here. Okay, is that clear, this point? Now this is from the point of view of issuer. Now let's understand from the point of view of investor. Now there is a difference. Here I have written here convertible, but I have not written here convertible. Okay, because if I write convertible, it will become what? No. What will the classification? See, if it is from the investor point of view, it's a financial asset. If it financial asset is a convertible to equity, it which classification? Convertible instruments, financial asset. Classification, FBT, OCI, amortized cost, or FBT P&L. Contractual cash flow test will pass or fail? Fail. Then what classification? FBT P&L, FBT P&L. Okay. So see, whenever you have to measure any instrument or record any instrument at FBT P&L, that is very easy, right? That's not a challenge. I have to discuss amortized cost. That's the reason I have removed the convertible part here. Okay. How to do that? It says accounting is very easy for this one. Understand? How do we record financial asset? You tell me. Okay. Balance B by D, or I'll go with bank account. Then finance income at EIR. Then contractual cash flow receipts. Then C by D. Agree? Now what it says, see, whenever you purchase, you will record at, see, this is in foreign currency, but you have to convert it to Indian currency, right? Applying the principles of India's foreign currency, India's is 21. Very good. So now when you purchase anything, you will convert at foreign currency date on the purchase date. Finance income you charge during the year or at the end of the year? End of the year. So you will take closing rate. Contractual cash flows you receive on a particular date. So you will take forex rate on the date of received date. Right? Now closing balance on the closing rate. Now all the things we have converted using different rates. There will definitely be a forex gain or loss. So that will be your difference. Difference will be forex gain or loss, which will be transferred to P and L. That's what. Okay. See, now read it. Record finance income at EIR in foreign currency and convert to presentation currency using closing rate. Closing rate. Record contractual cash flow at coupon rate in foreign currency and then convert to presentation currency using the payment date exchange rate. Calculate closing balance, that is opening balance plus finance income minus contractual cash flows in foreign currency first, then convert to presentation currency using closing date exchange rate. Okay. Now the difference will be transferred to P&L. This is for amortized cost method. Clear, everyone? Now what about FBT P&L or OCI? So you will take fair value on the closing date, multiply with the closing date exchange rate. Clear? Now any difference is accounted for as exchange gain or loss. If it is amortized cost method or FBT P&L, you will transfer it to P&L. If it is OCI, you will transfer it to OCI. Is that clear, everyone? So third item which goes to OCI is fair value gain or exchange gain or loss on financial assets at FBT OCI. Is that clear, everyone, so far? Now comes a concept on financial guarantee, which was tested in November 2022 as well. If I'm not wrong, I'll just show it to you guys. Financial guarantee, see, November 2022. And I'll tell you, there was no question on ICI material on this one. Okay. Yes, it might be in RTP, but it was not in ICI material. Okay. So, but yes, this concept has been tested in November 2022. Okay. So, understand this concept now. What happens? Subsidiary company goes to the bank for taking a loan. Subsidiary company goes to the bank for taking a loan. Now, subsidiary company is a startup company. Okay, subsidiary company is a startup company. Think of it as like a Reliance Jio. Okay, it's a very startup company. Okay, Reliance, a bank says, I will give you loan at the rate of 18%. Okay, now Akash Ambani went to take the loan. Bank said, I will give at 18%. So Akash Ambani came to Mukesh Ambani and told that father, he is telling me the 18%. Okay, let's go to the bank again. So Mukesh Ambani also followed the Akash Ambani to the bank. Now us just seeing the Mukesh Ambani, the bank says, no, I'll give it 13%. Why? Because holding company, that is a Reliance Industries, is giving a guarantee on behalf of Reliance Jio, right? As for this example, assume that Jio is a subsidiary of Reliance, but ideally it is not. Okay, for this example, you assume it off. Okay, so when a parent company gives a guarantee to the bank on behalf of subsidiary company, that is called as a financial guarantee given by the parent company. And due to this financial guarantee, the loan interest rate reduces. Okay, comes the question, how will the accounting be done in the books of S Limited and in the books of holding company? S Limited has taken a loan at the rate of 13%. So he will account for the loan at the rate of 13% following amortized cost method. Simple. But holding company has not taken any loan, but he is still interested in this loan, right? He is still interested in the risk of the loan. So he will have to account for the financial guarantee. He will have to account for the financial guarantee. Now, what should be the fair value of the financial guarantee? What should be the fair value of the financial guarantee? No. So it says the difference, or basically the savings to the subsidiary company. Just because I have given a loan to my subsidiary, what is the savings to my subsidiary? Tell me, 5%. So 5% savings is there on every year. So this is the fair value of the financial guarantee. To take an example, let me take an example. Okay, loan amount is 10 lakhs, term is 3 years. Okay, interest rate was 18% ideally, but due to guarantee it became 13%. Now let's calculate the savings. Year savings. Okay, now year 1, year 2, year 3. What is the savings? Tell me. 5% of 10 lakh is how much? 50,000. 50,000. 50,000. Present value at the rate of 18%. Can you please calculate? Please calculate the present value. Okay, 10714. Okay, this 18% should be, I've just taken it. It should be market rate of interest. Okay, it should be market rate. Now, assume there's 18% I have taken. Okay, because just because the subsidiary holding has given a guarantee, it is because of that the interest rate has reduced, right? So ideally, the market rate was 18% only. Okay, so I've taken that rate itself. Now, if the question clearly says market rate is this much, then take that rate. Otherwise, take the original 18% rate as a discounting rate. Okay. Now 108,714. So what it will record? Tell me. Holding company will record what? Tell me. Investment in subsidiary account debit to financial guarantee. How much? 108,714. Now let's understand it subsequently. What will happen? Not exactly unwinding here. This is not my liability. This is the guarantee. Okay. So no unwinding. Now please recall today's class. Initially what I told, there are 3 exceptions for financial liability. What was that? Please tell me, anyone. 3 exceptions of financial liabilities. One is the financial guarantee, right? Financial liability is measured at amortized cost. So if it is an exception, definitely it will not be measured at amortized cost, right? So it was measured at what? FVT PL. Very good. So here I will record investment in subsidiary account debit to financial guarantee 108,714. Right? Comes the question, At what value shall I record here, here and here? Standard says, and that's very much logical, calculate present value of savings, that is the unwinded value, calculate expected loss. Expected loss means what? If the subsidiary company is unable to repay, what is the amount that I have to pay? What is the loan amount? 10 lakhs. Okay. Please calculate the present value of the savings here. Can you please calculate and tell me? It is 50,000 here and 50,000 here. Please calculate the present value using 18%. $78,000 to 82. Very good. Now, expected loss is, let's suppose, nil, meaning thereby I assume that the subsidiary company will repay the loan. So I will measure it at 78,282. Means what I can write is higher of. Okay, you understood the logic of higher? Let me explain it one more time. If this expected loss would have been, let's suppose, 1,50,000, meaning thereby the loan amount was 10 lakhs, but subsidiary company will be able to repay only 8,50,000. 150,000 I have to pay. So do you think it will make sense to record the financial guarantee at 78,000? No, because I have to pay how much? 150,000. So I have to record the guarantee at 150,000 now. So that's the reason why I have to record it higher of. Okay, higher of. Now, but whenever I do this one, so will I record this as financial cost? No, I will record as remeasurement gain or loss, whatever is the amount. Okay, so if it is 150,000, the differential. If it is 78,282, the differential. Whatever is the difference will be transferred to P and L. Okay, same thing I will do here and here. Okay, is that clear, everyone? Let's suppose here the loan fully becomes repayable by me. Okay, so again I will calculate present value of savings and I will say expected loss is 10 lakhs, right? Higher is 10 lakhs. So I will again remeasure and take the loss to P and L. Clear, everyone? Is financial guarantee clear? Now, coming to derecognition or modification of financial liability. Understand, the derecognition of financial assets, we told that it can be derecognized partially, it can be derecognized fully. Okay, but for financial liability it doesn't happen that way. Okay, either we have to settle it fully, then we have to derecognize it, because there is no risk. The risk is with us to someone else. Okay, we don't have any risk. Okay, so either we can settle it fully now or we will continue with the old loan. So we have to see whether we are settling it or continuing with the old loan. Now what happens, many a times, mostly in the case of banking or NBFC companies, they give a loan to the companies, okay, but the companies are unable to repay the loan. Okay, now options with the company is, first, bank do have an option to waive off the loan. Okay, then derecognize. Okay, second is option with the bank available again is restructure the loan. Basically give some time to the entity, to the company who has a liability, to adjust his financial statements, to earn some profit and then repay the loan. Okay, so these are the two options available. Now the second one is called as corporate debt restructuring. Okay, debt restructuring. Now whenever the debt is restructured, so definitely the terms and conditions which was there in the old loan gets changed completely. The payment terms might change. They will say that for the next 3 years, don't pay me anything. Okay, modify your company, basically try to earn your profit, revive your company, and then when you start earning profits, start paying the money back to me. Okay, so that is given to encourage the companies to to survive. Now in these cases, I have to assess when the terms are changed. Okay, I'm not discussing about waiver. I'm discussing when the terms are changed. I have to assess whether the loan has to be derecognized or the loan has to be modified. How will I do that? So step 1 is calculate the carrying amount of the financial liability on the date of modification. Okay, when the change in the terms and conditions happens, on that date, first calculate the carrying amount. Okay, then calculate the revised value of financial liability based on the revised cash flows. Basically based on the revised terms and conditions, calculate the revised value of the financial liability. using the new discount rate, that is the discount rate on the date of modification. On the date of modification. Okay. Now you have to see the change. You have to see the change. That is, what was the current liability minus what is the old liability and how it has changed. Calculate the percentage. If this percentage is up to 10%, means the loan has not changed significantly. If the loan doesn't change significantly, I'll say I will continue with the old loan. If the change is more than 10%, okay, then I will say the loan has changed significantly and I have to apply extinguishment accounting, meaning thereby derecognize the old loan, recognize a new loan. Clear, everyone? Now, so this is just an assessment. This is just an assessment of whether which accounting I have to apply, modification accounting or extinguishment accounting. Now, after doing this one, I have to understand the accounting treatment for both the cases. Okay, what is the accounting for modification and what is the accounting for extinguishment? Now, modification, as I said, modification is the continuation of the old loan. So what I'll do, what is the carrying amount of FL on the date of modification? What is the revised value of FL based on the revised cash flow and which discount rate? Which discount rate? If it's the if it is the continuation of the old loan, which discount rate shall I use? Old discount rate. Old discount rate. Students get confused here. I shall use new discount rate or old discount rate, because we have used new discount rate here. We used new discount rate here because we were assessing it now. Once concluded that it's a old loan only, use original discount rate only. Whatever is the change will be transferred to P&L. Means this is your carrying amount. This is the revised value for financial liability. Difference transferred to P&L. If any transaction cost, transferred to P&L. Sorry, financial liability, not P&L, financial liability. But if it's the extinguishment of the financial liability, means de-recognize old FL, recognize new FL. Tell me what will you do? First, you will de-recognize the old FL. Any transaction cost, if you incur, transfer to P&L, because that was pertaining to the old transaction, old FL. Now you will recognize a new FL at a new discount rate and continue the accounting for that. See, de-recognize old FL at its carrying amount, recognize new FL at new discount rate, transfer transaction cost to P&L. If there is any difference, it will transfer to P&L. Is the accounting treatment clear to everyone? Okay. See, understand the whole difference between modification and extinguishment is 2. First, here we do not de-recognize anything. Okay, we just recognize difference between old and new FL in P&L. But here what we do, we de-recognize old and recognize new. Okay, now when we calculate new here, that is at old discount rate itself, because we are continuing with the old loan. But when we calculate new here, we calculate with new discount rate. Is that clear, everyone? Now, coming to derivatives. But before we move on to derivatives, tell me guys if you have any queries in this one. Anyone having any queries?
We are using the original discount rate for the cash flow of the So what rate we have to use for amortization?
The rate which you use for discounting is the rate which you use for, yes, coming to that. Now, the rate which you use for discounting is the rate which you used for unwinding. If there are no transaction costs, again we'll use the same rate for unwinding. If there is a transaction cost, we'll calculate EIR. Same logic for amortized cost. Again, for new FL, it's a new FL, no transaction cost. The transaction cost which we paid goes to P&L only, right? So that is not adjusted with FL. So the rate which you use for discounting, that is the new discount rate, is the rate which we use for calculating the unwinding also. Clear? Now, moving on to the next concept, that is derivatives. Now, can you please tell me what are the three characteristics of a derivative? Three characteristics of derivative? Lesser, no, low or nil. Lesser means comparative, right? Lesser is used in the terms of comparative. So use low or nil investment. Tell me then. Settled on what date? Future date. Okay. Derives its value from underlying. Okay. So low or nil investment settled at a future date derives its value from the underlying. Okay. Now accounting treatment. Derivative liabilities or derivative assets. Okay. Are what? Remember this one. Finance. Remember the definition of financial asset and financial liability. Please recall that. Contractual right to exchange financial asset or financial liabilities in potentially favorable condition. Contractual obligation to exchange financial assets or financial liabilities in potentially unfavorable condition. Now, if it is unfavorable condition, it becomes what? Derivative liabilities. If it's potentially favorable condition, it becomes derivative assets. Okay, so derivative can be derivative liability, derivative can be derivative assets. Okay, now both of which has to be measured at FVTPL. Clear everyone? Now see, these contracts are classified at FVTPL. Any transaction cost is recognized where? P&L. Now, on the initial date, let's suppose, see, let me give examples of derivative contracts. Forward contract, future contracts, call options, put options, right? It can be any other, right? Now, in forward and futures, do we pay any amount initially? No, right? No. In forward we don't pay any amount, right? So initially no entry. But in call or put we pay premium, right? So that premium is derivative asset account debit to bank, right? Now during the term, whatever is the gain or loss, we recognize either a derivative asset or we recognize derivative liability. On the date of settlement, we pay or receive the derivative liability or derivative asset and settle the transaction. Is that clear, everyone? I'm not taking any example on these ones because it's very simple, right? Coming to embedded derivatives. Now, what is the meaning of embedded derivatives? There are certain, basically what happens in a derivative contract, we intentionally enter into a derivative contract, okay? But in embedded derivative, we don't enter into a derivative contract, but it is tagging along with the host contract, okay? It is tagging along with the host contract. To take an example, we entered, basically I taught an Indian student, okay? From which I received the fees, okay? I have not received the fees, it's a receivable for me, okay? Is there any derivative element involved? No, no derivative. Definitely he will pay me the fees after 10 days. But let's suppose I taught a London based student, okay, for ACCA. Now what happens when I'm teaching that student, I will receive the fees in pounds, right? Now he told me that, sir, I'll pay you after 10 days. Don't you think I will have a risk in the mind, right? The risk of foreign currency fluctuations. That's called a embedded derivative. That's called an embedded derivative, okay? So the host contract is the fees plus the foreign exchange fluctuation is the embedded derivative element. So standard says whenever there is a host contract and an embedded derivative element, separate those and do the accounting separately. For the fees, I will record as a revenue. For the embedded derivative, that the foreign exchange fluctuation, I will record foreign exchange gain or foreign exchange loss, okay? Now, what does it say? Read here. An element of derivative is embedded in a normal host contract. The derivative contract and the host contract has to be separated. However, in following cases, the two need not be separated. If the derivative is of insignificant value, basically it says it's not that material that will take the efforts of separating it off, or if they are closely related, meaning thereby my business itself is to teach foreign students, okay? My business itself is to teach foreign students. So what happens? The fees is closely linked to pound. Okay. So now in every case I cannot say this is my fees, this is my derivative contract. No, I am closely related there. Okay, I am closely related. So that's what. Whenever it's closely, that is normal business practice. If it's a normal business practice, then I will not separate. If it's not a normal business practice, let's suppose I purchased an asset particularly from the US. Okay, that's not a normal business practice. Okay. So if it's not a normal business practice, definitely I have to separate it. Now how? After separation, host contract as per the applicable Ind AS might be revenue, might be the particular asset, or might be particular inventory, as the case may be. For derivative contract, as per Ind AS 109, as per derivative accounting. Clear everyone? That is as per FBT P&L. Clear everyone? Now there are two important cases on embedded derivatives. One is purchase or sale of goods or services in the foreign currency. Host contract is the revenue thing or the purchase thing, and the derivative is the foreign exchange fluctuation. Okay, that is foreign currency. So I'm not taking this one. This is a very easy one. But this prepayment option I feel is a very important concept. Okay, is a very important concept which I want to discuss with you guys. Now, what happens in a prepayment option? Many a times you would have heard that I am taking a home loan with a prepayment option, right? I am taking a home loan of, let's suppose, 20 lakhs for 20 years, but I do have an option to repay the loan during the term of the loan. But when I will repay, I will have to pay a prepayment penalty of 1% or 0.5%, whatever else the case may be. The question is, how will that prepayment option be treated? Understand, when I take a loan, that's a financial liability. But when there is a prepayment option, there is an option is a derivative, right? So along with the loan, there is a derivative component tagged along with it, which is called as embedded derivative. So the question comes up, how will I account for that embedded derivative? Now, let me draft an example and discuss that question with you guys. Okay, I have already drafted the example. Just a minute. Yeah, the question is already drafted. Those who have taken the book, but this question is not drafted in the book, so please you can write it off. Embedded this one, prepayment option. Okay, that's an important concept I feel for May 2023. Prepayment option. Let's write the question. The loan amount is INR 10 lakhs. Then interest rate, or I write coupon rate, is 10%. Okay. Now, loan term is 3 years with a prepayment option of at a 1% penalty. Now tell me, apply your logic and answer me this one. Whenever a loan is issued, whenever I as a bank will issue a loan to you, okay, so basically there are two parties. One party I have given a simple loan of 10 lakhs, one party I have given a loan of 10 lakhs but with a prepayment option. Tell me, will I charge the same interest rate to both of you? Where in the interest rate will be higher? Where I have issued the prepayment option, right? Because I am giving you an option to prepay, right? So the interest should be higher in this case. So the normal market rate of interest, so I'll write here the market rate of interest is 8%. Okay, but I have given here at 10%. Now account for host and derivative contract. Host is financial liability, right? I have taken a loan, and derivative contract. Please do the accounting. First of all, what will you do? You will separate the value of a host contract and the derivative contract. Let's do that. So tell me, what are the contractual cash flows? Year 1, 2, 3. What are the contractual cash flows? 10 lakh, 10% the coupon rate is 1 lakh, 1 lakh, 11 lakhs. Present value at the rate of what rate? 8%, right? The normal loan. Tell me, what is the interest? What is the present value? $10 lakh 540 is the value of the loan, is the value. Okay, now, but now tell me what is the value of the loan that I have taken? What is the value of the loan that I have taken? Tell me. So financial liability is 10 lakhs. So what remains? Differential is how much? 51,540. This is the value of prepayment option. Meaning thereby, since there is a prepayment option, this is what is the extra that I have paid at the initiation. Okay. Or to say it other way around, this is the present value of the 2% extra that I have paid. Right? Now, so this is what. Now, what will I do? Financial liability and prepayment option. I will do the accounting separately. Let's do the accounting for 3 years. I am preparing the ledger. Okay. Ledger will give you better clarity over the things. Initially by bank, how much I paid? Tell me. 10 lakh. Sorry, I have received in the bank. How much? 10 lakhs. What is the value of prepayment option? 51,540 if I am not wrong. Right. Now, what is the value of finance costs? Finance costs. What is the rate that you used to unwind? What is the rate which you used to calculate the present value? Tell me. 8%. 8% of this one, right? Tell me, finance cost at the rate of 8% is how much? 84,123. So now, what is the amount that you receive here in the bank? Sorry, you pay in the bank? 1 lakh. So what is the closing balance? What is the closing balance? 10,35,665. Is this clear for financial liability? Now let's prepare an account for prepayment option also for the first year. Okay. Prepayment option. Now here I write financial liability. How much? 51. What is the amount? Tell me. 51,540, right? Now year end. Derivative means FBT P&L, right? So I will tell the value at the year end. Tell me, if I will repay the loan today, what is the amount that I have to pay? Tell me. If I will repay the loan today, what is the amount I have to pay? 10 lakh plus 1% of 10 lakh means 10 lakh 10,000. Means 10 lakh 10,000 I have to pay, right? So what is the value of the prepayment option now? What is the value of the prepayment option now? See, what is the value of my liability? 1,035,665, right? Minus, if I have to repay the loan today, what is the value that I have to pay? 10 lakh 10,000. So what is the value of my prepayment option? 25,665 is the value of my prepayment option. What is the difference? Tell me. $25,875. Okay. Now first year is done. Clear? Second year. See, we have to do prepayment, right? So what I'll do is settle it the second year itself. Now B by D is 1,035,665. What is the finance cost? Tell me. At the rate of 8%. 82,853. Okay. What is the amount that I'll pay in the bank? 1 lakh. Okay. I'm just not writing C by D. Come to prepayment option here. What is B by D? 25,665. Okay. Now, when I will settle the amount, financial liability, tell me what is the amount that will be adjusted from here. What is the carrying amount? Please calculate what the carrying amount after this one. 10 lakh. Just a minute. 10 lakh 18,580. Okay. 18. Okay. Minus, if I will repay the loan today, what is the amount that I am going to pay? 10 lakh, 10,000. What is the amount that will transfer to FL? 8518. I will write here 8518. Prepayment option 8518. Now you pay in the bank how much? 10 lakh, 10,000. Just see if the account gets settled. Please check if the account gets settled. Right? Now here what I'll do, I'll transfer the difference to P&L. What is the amount? 17,147. So this is how accounting has to be done for prepayment option. Is it clear, everyone? So though I have not included an example here, but yes, I realize this is an important concept and hence I included it here. Okay. Now, financial assets. Again, a very easy concept: trade date accounting and settlement date accounting. Tell me, what is the meaning of trade date accounting and settlement date accounting? Trade date accounting means I will record the financial assets on the date of trade. See, understand, if I have purchased equity shares today, will I get the equity shares on my demat account today? T+2 settlement, right? So trade date is today, but settlement date is T+2, right? So that's what. So now what I do is, when I do trade date accounting, I will record the investment in today's date itself. Okay. So I will record financial asset account debit to payable if the amount is not paid today. Okay. Means I will enter into contract basically. So financial asset account debit to payable account. Subsequently at year end, it is at amortized cost. So no treatment, right? Because if it would have been at fair value, I would have recorded the fair value changes, right? Either in OCI or in P&L. On the settlement date, what I will do? Payable account debit to bank. If it is at OCI, the entry will be the same. But here, see, on year end, basically between trade date and settlement date, if the year end comes, between trade date and settlement date, if the year end comes, what I will do, I will transfer the fair value changes to OCI. Okay. And on settlement date, what I will do is same thing I will do, payable account debit to bank, and any fair value changes, if it is there, it will be transferred to OCI again. Same thing here. What I will do here is financial asset at FBT P&L. Tell me, transaction cost will be transferred to P&L. So financial asset account debit, transaction cost account debit to payable basically. Okay. Any fair value changes, P&L, same. Any fair value changes, I will transfer to P&L. Whatever is the amount payable, I will pay it off. Okay. Now, if it is settlement date accounting, on trade date, I will not pass any entry. I will not pass any entry on trade date. Now, year end fair value changes, will I account for in the amortized cost? No. But if there is a financial asset at OCI, I will have to record the fair value changes to OCI, but there is no asset recorded. So I will have to open an asset account called as fair value adjustment account. Fair value adjustment account, okay, and record the fair value gain or loss to OCI there. Similarly, I will record the fair value adjustment and record to P&L. Okay, this is an asset or a liability to be recognized in the balance sheet. Now, on settlement date, what I will record? Financial asset account debit to bank. On settlement date, what I write? Financial asset account debit to bank, whatever amount I pay to fair value adjustment. That is the gain or loss till year end. What is the gain or loss from year end till settlement date will be recorded as in OCI, right? Now, similarly here it will be P&L. Is it clear, everyone? Now, financial asset will be recognized at amount paid, and transaction cost will be transferred to for FBT P&L, P&L. Is it clear, everyone? Now, so that completes our discussion on a financial instrument. But yes, throughout the financial instrument chapter, there are a lot of discount rates used. Again, let's understand that. Okay, normal financial liability without transaction cost, we will use coupon rate. Financial liability with transaction cost, we will use effective interest rate. Compound financial rate, we will use market rate of similar instruments without conversion rights. Just a minute. I will use coupon rate, I will use effective interest rate, I will use market, is it visible to all of you? Market rate of similar instruments without conversion rights. Now, CFI, financial element component, the same rate, right? Because that's the rate which you use to discount, and that's the rate which we use to unwind as well. But CFI, financial liability component, if there is a transaction cost involved, tell me, effective interest rate, very good, effective interest rate. Now, financial liability, when we are checking for whether it is a modification or extinguishment, which rate will we use? New discount rate. Now, when it's a financial modification, original discount rate. If it's an extinguishment, new discount rate. If it's a prepayment option in a loan, market rate. Now, financial asset measured at amortized cost method. Tell me, effective interest rate or coupon rate. If there is no transaction, if there is no transaction cost, coupon rate. If there is a transaction cost, effective interest rate. Financial asset at off market rates, market rate. Financial guarantee, market rate. If market rate is not given, then not difference, the higher interest rate or higher interest rate. That is the rate at which the loan was issued to subsidiary company originally prior to financial guarantee. Higher interest rate. Now, third one is FA at ECL. Again, the same rate for FA, same as FA. The rate which we are using for financial assets is the rate which we will use for ECL as well. If you have to see, I'll just show it off. Just give me a minute. For ECL, I'll show it off to you. See, what was the effective interest rate for FA? 7.5. See, we calculated finance income at 7.5. We calculated this one, see, at 7.5. Right? ECL also 7.5. So does this clear the discounting rate thing? All of you, please, I will recommend, please take a snap of it. Even if you have not took the book, if you have taken the book, please write in the book. If you have not taken the book, please take a snap of it. Or if anyone wants, you can take it from here also, come and take, but share it with everyone. Done? Now, the last concept for the day is executory contracts. Did I discuss executory contracts with you guys? Briefly, I would have discussed, might be. Now, what is the meaning of executory contracts? Executory contracts means contract to buy or sell non-financial items. Okay. Now, whenever I intend to contract to buy or sell a non-financial item, the intent can be two. Let's say, yes, please. Okay. Now, so whenever I intend to contract to buy or sell a non-financial item, this is a non-financial item. I intend to contract to buy this after 2 months. Okay. Now, the contract can be settled by taking the delivery or can be settled on a net basis. Whenever I settle on a net basis, means I am just interested in the price difference, not the asset or the goods or services, whatever it is. Okay. So if it is for self usage, it is out of scope. Okay. Basically, now understand, if this non-financial asset is a PPE, it will be covered under Ind AS 16. If it is investment property, 40. If it is intangible assets, 38. If it is inventory, 2. Okay. If it is biological assets, 41. So whatever as the case may be, we'll cover it irrespective standards. But if it is used, intent is to settle on a net basis, then it is accounted for as a derivative accounting, derivative contract. Okay. Now understand how to decide. The question that comes up is how to decide whether the entity will go for self usage or on net basis. First and foremost point, past practice test. Past practice test means what? In the past, I have taken delivery. In the past, I have taken delivery means self usage, means out of scope. Clear? In the past, I have taken settled on a net basis. On a then derivative accounting, right, in the scope. In the past, what I have done, I have taken delivery and quick reselling. Means I purchased quickly, I resold it off. So again, I am not interested in the goods or services. It's in the scope and it will be accounted for as per derivative accounting. Now, entity intents. Now the entity is very much clear, okay, that I will settle this contract on a net basis. Even though in the past I have taken delivery, but this contract I will settle on a net basis, okay, very much clear. Then again, derivative accounting in the scope. Derivative accounting in the scope. Is that clear? That completes our discussion on financial instruments. Tell me guys, if you have any queries. Yes, please.
One is like trade receivable, you said we have to consider it as lifetime expected credit loss. But in case in question they are mentioning both.
See, trade receivable, I have not, I told short-term receivables. Okay, if the life is less than 12 months, then it will be to a lifetime ECL. Otherwise, not. If there might be a case that trade receivable is for 3 years, then we have to assess. It's not short-term in that case, right? So you have to assess on a case-to-case basis. So understand, there is a limit for lifetime ECL is that if the credit risk is significantly high or the asset becomes credit impaired, it's lifetime ECL. Generally, all other assets, financial assets, are to be measured at 12-month ECL. Okay. Any other queries? Yes, please.
Like in modification, we are transaction cost we are transferring to financial liability.
Right.
In extinguishment, we are transferring that amount to P&L.
Right.
Any specific reason?
No specific reason. It says that, see, that transaction cost was pertaining to the old FL, right? But we are taking a new loan now. So whatever is pertaining to old FL, what I told, any difference is transferred to P&L, right? Now, even if you transfer that to FL, what happens? That gets transferred to P&L only, right? Because we are de-recognizing the old FL fully. Yes, please. Pardon? Yes.
If first it is net basis, then the company wants to settle it into like self-usage.
Okay, so you're telling that intent changes subsequently.
Then should we like close the derivative or it should be closed at the end of the?
See, understand what happens is let's suppose the contract is for 3 months or 4 months. Okay, within these 3 months, if an year end comes up, okay, or not, leave apart year end. What happens within this period? Okay, the intent changes. Okay, then I will have to shut down the derivative asset or derivative liability, whatever it is. Okay, if at the time of settlement we have recorded derivative asset, but we want to no, I don't want to do net settlement. I want to take assets itself. So what I'll do, I will record a derivative asset. Whatever amount I have to pay, I'll record that. I will take the delivery for that. Okay. So do one thing on yourself. Take one example. Okay. Take one example wherein what you have to, it's initially intent to settle on a net basis, but subsequently, right here, I have settled on a net basis itself or settle on a gross settlement basis also. Take an example and try to pass journal entries. Okay, your concept will get cleared. Even if there is an query, I am there. You do have my contact number, all of you, I believe, right? So please WhatsApp me for any queries. We'll discuss and resolve it off. Okay, thank you. Just I'll stop the recording.